Live from New York City, good morning to you. Equity futures just about unchanged on the S&P 500. 2 days of losses on the S&P and on the NASDAQ too. NASDAQ futures trying to bounce up by 0.2%. Huge moves in the bond market, especially at the front end. The 2-year, Friday morning, 4.09%. This morning, even with a move lower of 3 or 4 basis points, 443.72. Tom, you've looked at the 2-10 spread. That number right now, negative 80 basis points.
I'm going to go to negative 81 basis points. And to be careful, folks, this is round trip off the joy that we saw off of, I think it was a Fed meeting and the Fed press conference. And now the question, John, is do we break through? That's the tension point on a Tuesday morning.
The 2-year is back to where it started the year.
Yeah.
Just think about that. We came all the way down to threatening to break into the 3s, and now we're back to where we started again. I'll tell you something else that's seen a round trip. Euro dollar last week, February 2nd, 110.33. Euro dollar right now, 10707. And having a little look at a 106 handle, that currency pair down 0.2%. You get a ton of Fed speak today. Chairman Powell speaks at 12:30 Eastern time. And then later this week, through the week, Williams, Cook, Bar Kashkari, Waller, all on the agenda. Their comments coming after the comments we heard from Lisa, from Raphael Bostic of the Atlanta Fed, who said this: if a stronger than expected economy persists, quote, it'll probably mean we have to do a little more work. And I would expect that would translate into us raising interest rates, Lisa, more than I have projected right now. Is that what you're calling full Bostic?
Full Bostic. The market is in full Bostic mode, or at least partly Bostic mode, because just to give you a sense of how much the market has changed its pricing of Fed policy. On Thursday, they talked about a peak Fed funds rate of below 4.9% in April, in March, and then 4.4% by the end of the year. Now we're looking at 5.1% peak Fed funds rate, going down to maybe 4.7%. So pricing out rate cuts and pricing in a higher terminal Fed rate, this changes the equation for assets in a way that still people are adjusting.
If we get more data like Friday, TK, I think those cuts get pushed off the table pretty quickly.
Yes,
that
I'll
data
agree
is just
with that.
stunning on Friday.
But the key thing you just said, John, is if we get more data, we are going to get more data. And what we're going to hear from the chairman today with Mr. Rubenstein is no chairman has ever been this data dependent.
Did you say inflation was on Valentine's Day?
It is on Valentine's
Exciting
Day.
stuff.
Thank you. Tiffany's let me know.
Bottle that, Tom. Bottle that.
Thank Tiffany's for mentioning that to me. She's been in Tiffany's. Cameron Dawson joins us now, CIO of New Edge Wealth, and thrilled to have you here. Cameron, I love what you have in your very sophisticated note about what the quote-unquote speculators are doing. And it's not Bill Gross you're talking about, the legend. You're talking about the degrossing that's going on right now. Explain to our radio and television audience what degrossing is.
Well, we've seen this utter confidence by the bond market that we're going to get much easier policy as we move into the back half of 2023. But we continue to see data that absolutely flies in the face of that, meaning that the strong labor market and inflation that does remain persistently high really doesn't support any kind of pivot by the Fed. So we have seen that round trip in a lot of the bond pricing just in the past couple of days, but we haven't seen it within equity markets yet.
No, continue, please. The equity market, I mean, it's amazing to me, the separation from bonds.
Well, that is incredible. If we think about why we've seen the equity rally to start this year, it's because we saw real interest rates fall. They started at 1.6%. They fell to about 1.1%, but now they're back up to 1.3, 3.5. And yet we have not seen valuations reflect these higher real interest rates. So we've gone from 23 times to start the year on the NASDAQ, but we're now trading at 27 times. That hasn't wobbled. And so we think that the real risk is now again back on the valuation front for equities because we're at the high end of historical ranges.
Cameron, whether the risk is in big tech or the risk is in the broader index, including some of the other names, is one of the key debates. Is this just a tech valuation risk, or is this across the board, all of the different companies that have rallied, including some of the materials and energy areas?
Well, I think that's a really interesting point, which is that if we look at the growth index, yes, we're back at the high end of pre-pandemic ranges, but we're also at the high end of pre-pandemic ranges for the value index because we've seen such a broad-based rally. And so it's really hard to make the argument that there's pockets of this market that are absolutely cheap just because the rally has been so broad-based. If we continue to see interest rates remain high, I think all valuations then would be at risk of rolling over.
Cameron, I get a lot of messages. They say that I don't get hate mail. I get hate mail. Tom mentions that frequently about how negative I am. And I imagine that you also get some hate mail or a lot of pushback, people saying, look, why can't you just be happy with good news? Why can't you be happy with the fact that we're seeing a robust labor market and the fact that...
therapy.
Well, I'm just curious, how do you respond to this idea that maybe we get no landing?
Is this the View?
Stocks do well?
Well, look, I think that at the end of the day, this rally was very much supported by positioning and sentiment being so bearish in the back half of next year or of last year. But then when we think about what the drivers can be, as we've talked about valuations, we're at the high end of ranges. So we don't think that we can push much above that. And then on the earnings front, yeah, a soft landing might mean that we have to throw out that worst case scenario on the EPS side of things. So those dire forecasts of 10, 20% down, they look less likely given the data that we have today. But what that means is that if we get that soft landing, it means we don't get the support from the Fed, which means that we don't get that boost to valuations that could really drive significant upside from here.
So are you basically joining the crowd of people going to Europe and basically hiding out in T-bills?
Well, look, I think that there is a valuation argument to make within international stocks. I think that we have to be very careful because international stocks have only had sustained period of outperformance over the US during distinct and protracted dollar bear markets. So by making a bet on international, you really are making a bet on the dollar, which means that you have to have the expectation that the dollar will significantly weaken from here, essentially to close that valuation gap between Europe versus the US, which has persisted now for over a decade.
Cameron, what's the price for being in cash? Right now, cash is a vogue, and all of a sudden, it has value. But in long term, which New Edge looks at, what is the price?
It's optionality. It's the potential that we could be wrong. And look, we remain invested in this market, and the way that we have navigated holding risk assets is being more tilted towards quality. So what we haven't done is we haven't upped our cash position a great deal. A lot of our asset allocation models might suggest that 4 or 5% cash flows are attractive, but you can't extrapolate them through the next 10 years. So that's why we continue to have this balanced asset allocation, knowing eventually risk assets are the place to be.
I look at this, Cameron, and John has mentioned this. John's been very good about this because I never look at the Standard & Poor's 500. But the fact is, the SPX is at 4,100 on February 7, 2023. The percentage of people out there that guess that is to the near side of nil. What do you do here? If you've had the year rally, how do you stay comfortable in equities now? Are there certain sectors you hide in? Do you directly hedge a downside? What's the approach of New Edge?
Well, I think that from the hedging of the downside perspective, it's one of the reasons why we remain overweight energy. We expected to have some weakness in energy just because of earnings decelerating quite materially. But at the end of the day, if we see oil prices rise again, gasoline prices rise again, that causes inflation to reaccelerate, other parts of the portfolio may not do so well. So we remain overweight energy. And then, as I mentioned, we keep that quality bias. We have not chased this beta rally simply because we haven't seen it really supported by liquidity, expanding liquidity conditions. And so what we're doing is we're saying maybe if we do need to raise cash for liquidity needs, we're going to take it out of those higher growth parts of the portfolio, because those are the ones that are the most sensitive to further downside if the Fed stays tight and liquidity remains scarce.
That's what's rallied really hard to start the year. Cameron, thank you as always. Cameron Dawson there of New Edge Wealth. Tom, you talked about 4,100 on the S&P. We spoke to Laurie Cavazzini yesterday. That's her year-end price target.
Yeah, there's going to be a lot of that.
That's her year-end price target.
This is really important, folks. It's okay to be a strategist and say we're going nowhere 12 months out. That happens more often than you'd think.
You want some strategy, some pushback? Marko Klanovic at JP Morgan publishing yesterday afternoon.
I'm afraid to ask.
He said the payroll report on Friday pours cold water over the Goldilocks soft landing narrative. He went on to say, Lisa, risks are shifting in the direction of higher developed market terminal policy rates and ultimately expecting now 25 basis point hikes in March and again in May. And I think some people wondering whether they go even further than that.
Well, and he's not alone. This is actually across the board, people resetting after what we saw on Friday. Ellen Zentner over at Morgan Stanley talking about the pause, how the data was going to come in negative and the Fed would adjust to that. She said yesterday that this changed the baseline forecast, what we saw on Friday, to a 25 basis point hike at the March FOMC. It also boosted the chances of bigger hikes down the line. So we see the same thing from JP Morgan, the same thing from Morgan Stanley, the same thing from Citigroup. Andrew Hollenhorst's team has been basically more hawkish than others. This groundswell is basically getting behind this idea.
That begs the question, does Chairman Powell have a job to do today or not?
He has a job not to disrupt this.
Does he have to validate it?
Yeah, I think so. I think if he wants to be successful, if he basically comes out and he says, we're looking at the labor market, that's what we're most focused on. We're data dependent, yes, but honestly, look, we're looking at the data and clearly the markets are as well.
I'd love to hear his assessment on financial conditions again. I'd love to see him given another opportunity to address the question and see if he answers it any differently.
They're sustained. They're sort of like the equity market, as Cameron mentioned. You've got a division of bonds versus equities, and the Bloomberg Financial Conditions Index is equity-like, is how I'd put it. And John, this is with the Dow closing just below 34,000.35 positive standard deviation. That's not a bond statistic. That's a equity-like statistic.
Equities have made a move. Bonds have made a move. Fixed income's made a monster move. We've talked about high yield spreads. They've tightened by something like, what, 200 basis points?
It's been insane.
From the white last year?
He can't say that the financial conditions are the same as they were 2 months ago. What he could say is, we're monitoring that as a transmission mechanism. We hope that it reflects the data as we will and our policies will. I'm just throwing out some language that could
I was looking at the rally in triple Cs.
Yeah.
The junkiest of junk.
How about non-profitable S&P and NASDAQ tech companies?
That's where the performance has been.
That's a short cover, I would suggest. And frankly, in bonds, I'd say the same thing, a massive short cover, and that's bond price up, yield down until 2 days ago.
You know what Doug Cass is talking about? Huge focus on really short-dated call option activity. Just massive volume.
Yeah.
Seems like that keeps coming up, Tom.
It comes up, and that's part of the liquidity story. That was something that Taleb cut his teeth on. Other thing Doug Cass is focused on is spring training is like days away.
When's that start?
It starts when we go down there as a team. I do admit we can't do the Red Sox. We have to do Yankees baseball.
You just go to Tampa and watch people throw
No,
balls.
we stay at the hotel across from
My son's going.
Bird's Steakhouse.
Is he going to spring training?
With his baseball team.
Oh, great.
Yeah. It's like all of the high schools.
Is he turning pro too?
We can go by.
Definitely not.
He's not turning pro.
Absolutely not.
Does he know that?
Let's discuss later.
Oh, that's
Look
mean.
at those markets.
I hope he's not
he
listening.
doesn't.
Do you not encourage your son?
I think it's wonderful.
You give him reality checks as well. 5 home runs, Mum. And then Bramo turns around and said, what is there to be happy
You
about?
sound like a scarred soccer player.
Seriously.
You sound like a scarred soccer player.
What is
Not
this?
at all. I mean, you know, the number one lesson I took from my dad after playing football,
here we go.
the boots were always dirty. You'd call them the cleats. And he said, son, they are your tools. And I'd go
That's the way
outside and clean
Grealish
them.
plays.
Go outside and clean them.
What does Man City mean for Jack Grealish? He's a gift of God. I love watching
Let's
him.
see. We're going to talk about what happens when a high-flying club gets relegated and what happens with some
They would be
superstar players.
relegated, really?
The prospect of that happening, and there is precedence, it's happened to Juventus before, so we've seen that happen. And some of their biggest stars carried on playing in the lower league. Do you want to talk about that next? We'll do that next.
Is it
Live from
next?
New
I
York.
didn't know that.
This is Bloomberg.
Nice segue.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Search and rescue crews from overseas are deploying in Turkey a day after a pair of powerful earthquakes left more than 4,000 people in the country and Syria dead. Turkey's defense ministry said the military has started evacuating some of the injured via Navy ships. Millions have been suffering without power or heat in the cold. It appears that Bed Bath & Beyond will be able to avert bankruptcy. Bloomberg's learned the home goods chain has lined up investors for an 11th hour cash infusion. The company plans to issue convertible preferred securities in a deal that would ultimately raise more than $1 billion. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The
compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
We're still looking at a recession happening sometime this year, but a shallow one where essentially the Fed is not successful in its mission in bringing inflation down to a 2 to 3% target. Double-dip recession is most likely what we're going to see over the next few years, because there's going to have to be serious damage done to the labor market to get inflation down this cycle.
Tom Titsouras, fantastic yesterday from Strategas on fixed income in this labour market, live from New York. Here's the price action. This morning, equities unchanged on the S&P. Was trying to figure out what day it is. Tuesday, right?
It's
Tuesday. Okay.
Nailed that, John.
Keep up, John. Keep up.
Nailed that.
In the bond market, 10-year, 363.98. You know, when I first started the early shift, I used to write down every morning at the top of my nose what day it was, because I'd always forget. Can we get to the big story of the last 24 hours? It's not in financial markets.
You know, we've got to, and you know, John, I think it's just extraordinary. Say what you got here. We're riveted by this.
Well, let's work through it. So Manchester City, high-flying football club in the United Kingdom, under investigation for more than 100 violations of financial regulations between 2009 and 2018. If the club is found guilty, they could face a range of punishments, including expulsion from the Premier League. The two-time defending champions reacting to the news and saying the following: the club welcomes the review of this matter by an independent commission to impartially consider the comprehensive body of irrefutable evidence that exists in support of its position. As such, we look forward to this matter being put to rest. Tom, once and for all.
Lots of three-syllable words. What I'm going to do is say what any American would say about soccer is, are these guys the Astros? And actually, it's way worse from what I can tell than the allegations against the Houston Astros. Here's a great paragraph from the New York Times. John Farrell, ace soccer expert, brought this up for me. Bring it up if you would here. And John, this goes into the detail, the minutiae here of what you and Giles are going to talk about. Season by season, the statement detailed each of the city's allocated transactions: P13, C71, C72, B13, C79, C87 for the next campaign, and so on.
I mean, you can laugh at this, but actually what was fascinating about this is that the Premier League put out this statement almost at the same time they were on the phone to Manchester City, informing them that this statement was out, and then everybody started reacting to it. Giles Turner is one of those that had to react to it, a managing editor out of London. Giles, can you just go through the accusations here and work out the timeline for how long this might take?
Well, the accusations are bizarre in themselves. You make a really good point about that paragraph. I mean, you can barely understand any of it. It's not something you welcome, for sure. You don't jump out of bed with that sort of stuff. But if you try and analyse it, what really matters, I think, is the Premier League accusing Man City of being essentially dishonest about its accounts for the past 9 years. Imagine that for a large bank. There'd be turmoil in the markets, for example. And it's the same thing in the football world. Regarding how long it's going to take, I mean, both sides, both the Premier League and Man City, are going to have some of the best lawyers in the country dealing with this. So given they're paid by the hour, I can't tell you how long it's going to take. Maybe a few months at the very minimum, but it could stretch to years. There's various different ways they can appeal. It's not like it used to happen. They had this whole thing again with UEFA 2 years ago, and you could argue they won. They still got a €10 million euro fine after they appealed and lost the original case against similar criticisms. So that took ages. This has been going for 4 years already behind the scenes, so who knows how long it's going to take.
Giles, can you give us specific examples of what they're accused of?
Well, you can. There are some things, for example, about the manager getting extra payments on the side, allegedly. People's agents getting paid extra on the side. These are obviously alleged, but that's not the real issue here. The real issue is the accounts. If a club can't honestly say what its accounts are over the past 9 years, that's a huge deal. And I think if they're found guilty of that, there'll be very big repercussions.
Giles, I'm going to be very delicate here as the ugly American, and John, I'm sure, could ask this question more delicately than I can. The stereotype here is petrodollar money acquiring British sports. Do you, in your reporting, or frankly, British reporting, Jason Bird and the rest, do you assume there are other petrodollar owners that are just as guilty?
Well, I don't think you can say that. I think there's plenty of potential buyers in Qatar, for example, who have been looking, we've reported this, looking at certain clubs that are up for sale, including Liverpool and Manchester United. And they might be looking at this and thinking, well, why are you perhaps picking on Man City? This isn't a good, if we come in and we want to spend incredible amounts of money, are we going to end up in the same boat, regardless of whether we do anything wrong or not? I think there's probably a bit of skepticism, maybe, but there's also a lot of schadenfreude going on here. Lots of people want to see Man City punished for this, right? So, I mean, maybe a case of, well, we'll come in, we're going to buy Man United, and we'll show you how it's done and do it properly.
Joining us now, Bloomberg surveillance football expert Jonathan Farrow. Jonathan, I want to ask you about the reality. The theater this weekend is Tottenham took them 1-0. I button the jacket and look like it's the BBC.
Okay, let's go.
Here's what I want to know.
I can't talk like that.
Grealish,
I'll do my best.
I am so dumb. Even I know Jack Grealish is stunning. And the guy for the Tots did a great job, Emerson Royal, of defending Jack Grealish. What's all this stuff that Giles talking about mean for Mr. Grealish?
Well, it depends what happens ultimately to the club. Do they face a points penalty? Does it mean they fail to qualify for the Champions League? Do they get relegated? Does that mean that some of those high-flying football stars will have to leave? In fact, what's interesting about getting relegated, there was a match-fixing scandal back in Italy in about 2006. Juventus actually got relegated from the top tier of Italian football. They lost some big superstars, and Buffon, one of the greatest goalkeepers of all time, in fact, he was the greatest goalkeeper in the world at that time, carried on playing for Juventus. I believe so did Nedved, so did Trezeguet, so did Del Piero. We're talking about some of the best players in football went into the lower league to bring Juventus back up to Serie A again. That's Juve. I think this is what's really interesting about this is that it's a different league. Serie A this year, Juventus got penalised again with a points penalty, and I won't get into the story as to why. There's always been a feeling that the Premier League has protected some of these big clubs and allowed them to do what they're doing. And Giles, what is interesting about this moment is governance of football in the United Kingdom. And Giles, I wonder if the pushback from Man City is there is a feeling here that ultimately this was the Premier League trying to get ahead of the government from saying, you don't know how to govern football, we do, we're stepping in.
Yeah, the last thing the Premier League wants is its own independent regulator coming in and stripping at some of its power. The Premier League's also got a new boss came in last year. She's very strict on this. I think perhaps it's a power play, but also it is a bit of a... You can't really read too much into a coincidence. This white paper was supposed to come out yesterday, then it got delayed. But I mean, look at the UK government right now. It's, you know, you can't predict what is going to happen from the UK government, so I wouldn't read too much into it. But certainly the Premier League wants to get ahead of any potential regulation that could strip it of power.
This is the reason why, actually, John, I was wondering what the discomfort level is with foreign investment cutting into a lot of these London leagues. And this really builds, Tom, on what you were talking about with respect to, is this a petrodollar thing, or is this just foreign investment coming in and taking over the culture of London football?
Well, certainly there's been some pushback around that for a while. You've also got the Saudi investment in Newcastle. It's an international game. It's an international game, and that's not going to change. This is about not whether Manchester City had the better team. They clearly had the better team on the day. It's not about that. It's whether they broke the rules to put the better team on the field.
Okay, so let's say their medals get taken away from them, their championships. Will people still think Okay, well, they did win, so they'll still get the support,
Well, I
right?
mean, if you ask a Juve fan about some of the league titles that were taken away from them, whether they still consider them theirs, I think they do.
100%.
I don't think that's changed. Giles, great to catch up. I think we're going to be talking about this again for a while. Giles Turner there of Bloomberg out of London. TK, just fascinating story of a very, very popular game for a moment where the Premier League is probably one of the most, if not the most, popular leagues in the world.
Come on, you got me hooked on this, folks.
Hands down.
You know, people say to me all the time, I mean, I went back and forth with the Tots after the victory this weekend. How did I pick the Tots, folks? I didn't pick the Tots. Farrell picked the Tots for me.
At the time, I said West Ham.
He looked at me.
I said you should support West Ham.
But I couldn't do West Ham because the guy went from Richmond over to West Ham. So I said, what's the posh team? And he said, Adele loves the Tots. And I said, duh.
Is that how it happened?
Great. That's how it happened. Adele loved the Tots. John, Lisa, help me here. Was he auditioning for Sky TV there? I think he was I'm sorry, folks. I don't know what to say. That was a.
Why are you trying to get rid of him?
John,
This is
you
ridiculous.
were born.
He's always trying to get him to
John,
move back
you
to
were
London.
born to do
Are you
this.
seriously?
Would you like me to go somewhere else?
You got the name, Jonathan Farrow. They can give it the Italian. I mean, it's like a no-brainer. You got the name
the sports
to do it.
cadence
You
to
got
the delivery.
You got it down cold.
I've already said what I'd love to do. What I'd love to do Monday to Friday, Bloomberg Surveillance. Then on Sunday, I'd like to do the Italian football. I mean, this is an audition if you want. I mean, I've always wanted to do that. I'll take you with me.
We'll just put a
We'll
remote
do that.
cam.
Can you imagine watching that? TK and I.
That would be fantastic.
Commentating on Italian football.
John, Davide, Sarah. It works perfectly.
Davide, Sarah talking about Italian banks at the same time.
Great.
Oh,
we go to
riveting
Lake
stuff.
Como, push Francine aside. Francine, talk economics. We're talking Italian football. Push her into Lake Como.
We go on a tour. You know what the absolute dream, though, is? If you could be a Formula One commentator and just go around the world and follow the race calendar. That's pretty cool.
Any other dreams that you wish to unfold?
I want to make ice cream, retire on a farm. There's plenty of stuff I want to do, guys.
All right, well, don't leave us just yet.
Daryl Cronk's going to join us shortly.
Did I get Sky TV right there? Are they the soccer channel in
They are,
America?
but I'm not going to Sky, Tom. That's so mean.
It was,
He's trying to get rid of me.
You had to put a cork in your mouth.
My emails are already lighting up from management. Here we go.
What are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We're seeing some indications that wage growth is slowing. I think that's probably enough to help inflation come down.
There was no reason to believe that any slowdown couldn't be addressed quite quickly if policy eased or if inflation came down.
We don't know where we're going to terminate the funds rate. It could be 5, 5.25, 5.5.
There's a consensus within the Fed that that's reasonably restrictive, maybe not perfectly restrictive, but also maybe too much.
It's not going to be painless to bring your monetary stance from super accommodative to restrictive. There will be a price to pay.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Huge day ahead down in Washington, D.C., live from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures unchanged on the S&P after 2 days of losses. TK, the Fed and Chairman Powell's next move in focus big time.
Chairman Powell's got to get briefed on the bond market, which is signaling, and there it is, John, just as we speak, 4.44 rounded up on the 2-year yield. You are there with an 81 curve inversion. The bond market is getting out front of the chairman's comments at 12:30 today.
What a turn, Bramo. We've gone from close to 4% to 444 in, what, 3 trading days?
Yeah, it's just been an incredible move, especially because there's also been a complete shift in terms of the terminal rate for the Fed funds, as well as the potential cuts or non-cuts for the Fed's funds rates later this year. You know, Tom, you always talk about the courage to be bullish, the courage to be invested. Where's the courage to be bearish at a time when so many people are talking about the potential for no recession?
Darryl Cronk's alongside us, and he can't stop laughing already. He's like, I'm prepared for this. Get your answer ready. The courage to be bearish.
Well, because there's so many people who have been burned again and again betting against this rally. And so how do people say, look, you get rate hikes, and they're going to torpedo the rally, and there's going to be some sort of downturn?
That's the pep talk at breakfast at Bramo's house on the weekend.
Jay, hold my hand,
the
Darryl,
courage
please,
to be
hold
bearish,
my hand.
kids.
Darryl Cronk's going to hold my hand with Wells Fargo. John, State of the Union tonight, and it brings back JFK, and everybody at the time had to read the World War, whether you're Republican or Democrat, didn't matter. You had to read Profiles of Courage. Coming this Christmas, Bramo, Profiles of Bearish Courage.
And President Biden with the courage to be negative on everything later on. You think that's going to work?
No, I think that this is important
You
because
catch
there are
your
all
breath.
these people who are being bearish and who have been burned again and again with the NASDAQ, the non-profitable companies that are doing really well.
We don't need a promo of you and I for this show, Tom.
We don't need to be on the show.
Lisa's
Just put the
great
Bramo.
bearish hits. Equity futures, look at this, unchanged.
She's
It's a positive,
gonna
a
go
tenth of
brief?
1% on the S&P. I'll keep this brief. Yields unchanged on a 10-year, 364 on a 10-year. Lisa, euro dollar, 107.07.
So let's hear what Fed Chair Jay Powell has to say. Over to him at 12:30 p.m. today. He does make remarks at the Economic Club of Washington, D.C., with David Rubenstein moderating that and discussing with him how much he wants to lean into this move that we've seen on the front end. Just to give you some perspective, 12-month T-bills are now yielding about the most going back to 2001.
This is a big deal. Thank you.
It is a big
Thank
deal
you.
because you're talking
Describe the
suddenly
chart.
4.8% in terms of what you're getting to park your money in T-bills for 12 months. There is an opportunity cost to not go into other assets, but this changes the equation for things like non-profitable tech companies as well as high-yield debt that used to yield 5% in and of itself, all in. We're also getting French Finance Minister Bruno Le Maire and German Economic Minister Robert Habeck going to Washington, D.C., talking about the Inflation Reduction Act. And the reason why I find this most interesting is because it comes ahead of the State of the Onion, as you put it, Tom, the State of the Union address, where President Biden is going to talk about domestic supplies to go into infrastructure spending. That discussion is at 9 p.m. with the State of the Union address that right now is getting pared down. Going to talk a lot about taxes for billionaires.
Taxes
share
that won't
buybacks,
happen.
Taxes that
Just
won't happen.
Policies that won't happen.
But that's the reason why I think that the Made in America stuff is actually more interesting,
Agreed.
especially in light of what the Europeans are saying and what they're doing in terms of lobbying the government right now.
Well, looking forward to the conversation with Anne-Marie in about 10 minutes' time. Darryl Cronk with us, the CIO of Wealth and Investment Management at Wells Fargo. Darryl, good to see you.
You too, John.
Do you have the courage to be bearish?
We have had the courage to be bearish for all of 2022. Look, I think you'll hear, to the earlier conversation, two mixed messages on jobs today. You're going to hear Powell at the Economic Club say he's concerned about the economy overheating and too many jobs, and then President Biden's going to get up at the State of the Union and tout how he's done such a great job creating jobs, right? So you're going to have this kind of dichotomy that's going to happen. I think, you've had a subtle change since the Fed meeting. Obviously, the point about 35 basis point move in the 2-year, the dollar's reverse course, gold has started to come down. You have a different message right now on the equity market between technicals and fundamentals.
Your path was wrestling economics and finance at Ames, Iowa, and then off you went to Zviebody and BU.
That's right.
And the bottom line is you need the courage to buy quality right now. All the media razzle-dazzles and nonprofit tech, meme stocks, is that what they're called?
Sure.
And the rest as well. And what Wells Fargo is saying, get brave and buy quality. Define quality.
Well, quality is everything that wasn't this rally at the beginning of the year. So there's only two themes that have driven this entire rally at the beginning of the year, including across all assets. It's long duration assets, and that's not just equities. Think tech, comm services, discretionary. Gold's a long duration asset. It's rallied hard this year, right? For up until the Fed meeting, the long end of the bond curve rates were still falling and were rallying. So you're getting this huge long duration rally, and then it's low quality, right? It's all the things you don't want to own, basically, that were just either some form of a January effect, some form of short covering, or some form of just reversion to the mean after tax loss selling. That's not really the basis for a good, sustainable rally from here, right? Now you coiled the 50-day, 20-day, and 200-day moving averages into a tight band that had to break out one way or the other. They broke to the upside here in the short term, but all near-term indications suggest you're probably overbought at this level. So we would fade this latest rally. We still think it's probably a bear market rally, a la 4 or 5 of them in 2022, and probably fails into resistance and eventually comes back down before you move higher.
How do you fade it? Do you fade it with options? Do you bet against the NASDAQ? Do you bet against specific companies? Do you just sell on the margins what's gone up?
I think you sell on the margins. It's giving you a second chance, to unwind that lower quality if you want to, or you just reduce your equity positions. You take your risk budgets down in portfolios like you need to if you don't have them where you want to be, and then you hold that dry powder to your point of you're getting paid handsomely on the short side of the yield curve to hold dry powder, and you're actually, for the first time in a long time, getting positive real rates, right? If you look at the 3-month run rate on the PCE deflator or the CPI, they're at 2.9, 3.1%. If I'm getting 482 on a 12-month treasury, real rates are finally now in a positive place. They hadn't been for much of all of last year and the year before. So that gives you some nice carry while you wait out as this thing the fundamentals catch up.
How distorted is your portfolio right now, weighted to fixed income, weighted to short-term debt versus equities versus other assets?
So it is definitely underweight equities. There's no doubt about it. We had, on the fixed income side, we were overweight fixed income, but we barbelled the whole fixed income element. So short-term makes all kinds of sense. The belly of the yield curve, you don't want to be there, right? Because now you have, instead of roll down, you have roll up in the yield curve, which is not the place to be. And, the 10-year peaked out on October 24th. We went long duration on October 29th, so we were 5 days late. But that's been just a heck of a trade, right? I mean, it has really added, mid-double-digit returns to portfolios. At this level, I'd be a little careful legging too far into the backside of the yield curve. We think the 10-year trades between 340 and 390 for most of this year and back and forth. So I'd be a little careful here at the level we're at today.
This tees up the next question, really. If economic data keeps surprising to the upside, like the data we got on Friday, would that change anything for you? How would it change things for you?
Well, the obvious is it has to price in more hikes, right? It brings May into the conversation, right? Which today, it's all about March is now basically a given, and then another 25 basis points in May, and it takes out any hope of cuts in the back half of the year.
So good news, bad news?
Yeah, I think that's the case right now. I mean, you just have to you have to let this thing play out. I mean, earnings growth is just now turning negative, right? In the last 20, 30 years, we've only seen that happen 4 times. Every time we've seen it happen, it ends up being a recession. Yesterday, you saw the Fed's senior loan survey. Financial conditions are tightening quickly, right? So every time you think about a recession, you have 3 things that happen. You have interest rates have to go up, you have inflation spikes, and you have lending and conditions tighten.
Do you think the chairman's more focused on the loan survey than perhaps what's happening in public markets?
No, I think still he's focused on financial conditions too easy, right? I mean, you can look at a whole bunch of financial conditions to this time last year.
So
and
what
remember,
was Wednesday about? What was that about?
Well, Wednesday was his attempt to be hawkish, but the market interpreted as dovish.
Is that
right?
what that was?
Yeah, so he's going to try and walk that back, I think, today and in subsequent speeches to try and just continue to pound the pulpit about, like, we have more work to do, we're not there yet. And so I think that's an important thing for markets to kind of reconcile. The reality is the equity markets and the bond market have not believed the Fed up to this point. They just don't believe it.
Say things like the disinflationary process has started, I'm not going to hear the rest. Wasn't that the problem last week?
The problem, and that was what they were looking at, and that was what they were hoping about. Is it's just, that he kind of failed at the communication.
That's right.
Can we give you an evaluation of
Well,
one-year
year-end eval.
Absolutely.
Year-end eval? Sarah House killed it. We've got
she's
different
great.
people we talked to
She's
who killed
wonderful.
it. And she described better than anyone I know this path of disinflation down, and she used the Amazon challenge of the last mile to get to your house, getting from 3 to 2.
Yes.
When you talk to Sarah House and you listen to Sarah House, what's your yield there that you're trying to get to? 3 to 2? Or are you even trying to get from 4 to 3?
Well, actually, I think that's the mistake the markets are making right now. And it's an excellent point, and I agree with you completely on Sarah. You did great on
She wrote me. She said, would you put in a good word?
So what the markets are missing is they keep using the inflation data on year over year. Who cares about last year, right? Last year at this time was irrelevant, right? Right now, as we speak, the rolling 3-month run rate on PCE deflator is 2.9, and on CPI at the core is 3.1. So let's just call it 3. At 3, you're a stone's throw away from 2 to 2.5 with still downward pressure on prices, right? So we're going to get there faster than what people think. That's what we wrote in our 2023 economic, our outlook was, look, the great surprise of this year is how fast inflation is going to come down. And if you think back in November, December, people were like, no way, no how, right? And it is. It's there already.
Well, that's why this market's got cuts.
Yes.
Dara Cronk of Wells Fargo. Dara, that was great.
Right.
Great year-end
Thank
eval
you.
there, TK.
Summary.
If you're over at Credit Suisse, if you're at the managing director or director level, wondering why your bonus is delayed, your eval's not happening for a number of weeks,
one person.
It's because TK's flying into Zurich to do your eval. Was that practice?
Right.
Was that practice?
Yeah, we're getting a huge response to the idea of going to spring training.
Okay.
We're getting a national response.
And they want us down there.
We're going.
We're going.
I got a date picked
on
up.
top of everything else.
We'll talk about it.
Just in case anyone was wondering, that was a joke. Credit Suisse has got big enough problems. They don't need TK down there. Megan Horniman's going to join us in the next hour, Chief Investment Officer at Verdance Capital Advisors, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The death toll from those powerful earthquakes that struck Turkey and Syria has now topped 4,000. Rescue crews are still searching through the ruins of thousands of buildings looking for survivors. Turkey's President Recep Tayyip Erdogan has declared an emergency rule in 10 of the country's provinces. In India, Adani Group stocks surged today. That's after the conglomerate's founders prepaid some debt and traders covered short positions. Still, the group is down $112 billion in market valuation since Hindenburg researched alleged fraud and market manipulation. One topic Adani executive says there's no change in the capital management plan.
Our plans are continuing as we have planned. Capital management is working. As far as the group is concerned, the group has adequately responded to all the concerns which have been raised. So currently, I personally don't see any challenge on the capital management plan side from the utility business perspective, what we are operating.
Adani has called the short seller's report bogus. An unpleasant surprise for some bankers at Credit Suisse. The struggling Swiss lender is delaying much anticipated bonus talks that had been set for today. Bloomberg's learned the talks may be rescheduled in the coming weeks. Credit Suisse would normally pay the annual bonuses at the end of February. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Today, Federal Reserve Chairman Jerome Powell sits down with Carlyle co-founder David Rubenstein live from the Economic Club of Washington, D.C. to discuss the state of the U.S. economy, the unprecedented actions taken by the Fed to combat inflation, and the indicators guiding the Fed's plan for recovery. A wide-ranging conversation live today. Bloomberg, your global business authority.
Dialogue and diplomacy is always important when it comes to a competitive relationship like this. We believe it's especially important when tensions are even further heightened. We're going to remain in touch with our PRC counterparts. I suspect there will be opportunities going forward for the Secretary to engage in that face-to-face diplomacy. After all, we didn't cancel this meeting, we postponed it. We postponed it until such time where it would be appropriate for the Secretary to travel to Beijing.
Ned Price there, the State Department spokesperson. The meeting, Tom, was postponed. It was not cancelled.
What an honor to speak to James Stavridis yesterday, somebody who joined the Navy at the bottom of the Navy coming out of Vietnam. And we talked about the courage necessary to go down 50 feet in ice-cold water.
Oh, yeah, sure.
Put a hook on this thing and
that's
bring it up.
serious stuff.
He really got emotional. I mean, he said, these are kids that are going to go down there. This is what they do. There's no, optionality. You are ordered to do it.
Yes, you don't get to turn around.
You don't get to turn. I don't think so.
It's too cold.
It was a real snapshot of the reality that we're not seeing within all the hysteria.
Big day ahead. You'll hear from the president a little bit later. You'll hear from Chairman Powell at 12:30 Eastern Time as well, sitting down at the Economic Club of Washington with David Rubenstein. Looking forward to that. Going into it all, equities look like this on the S&P, up around about 0.1%.
Resilient, right?
Resilient, Tom. Sure, if you want to say that. After a couple of days of losses on the S&P, down about 1.6% over the last 2 days on the S&P 500. On the NASDAQ, down about 2.6% over the last couple of days. Still pretty impressive gains, though, year to date. The S&P up about 7%. The NASDAQ, I think, 13.9% higher on the NASDAQ 100.
We're seen by the VIX, 19.44 is not the 23 that we enjoyed through much of 2022. I want to talk to Anne-Marie Horton about Ukraine and maybe where it fits in tonight's discussion. But Anne-Marie, we've got to go to Mr. Rubenstein's discussion with the chairman and also what the president will say about 1969 in a fully employed America. Let's be honest, institutionally, Powell and Biden are not on the same page. What will you listen for in your reporting on the Powell-Biden jobs report?
Well, listen, I think the president was given a huge gift coming into the State of the Union. He is able to tout this number. I mean, the last time the unemployment rate was this low, the president, who's 80 years old, was 26, 27 years old.
Oh, thank you for pointing that out.
So listen, if he does not start his speech with this, I will be shocked. I mean, I bet he will start his speech with this. We actually spoke to Brian Deese yesterday. He talked about how the economic part of the speech is really front and center, and it will be a major theme. He wants to try to convey to the American people, because it's not showing up in the polls, that the economy is getting to a better place. Inflation is starting to come down, the jobs market is picking up, and there is this window for a soft landing. And I guess that's really what we want to hear what Jay Powell has to say, because he's the one who's really going to be able to be more of a predictor, which Brian Deese says the president will not be an economic predictor-in-chief tonight, but maybe potentially Jay Powell will get some more insight on that.
How do they treat Ukraine? Suddenly, it's almost a second-tier part of this with China and all the rest of it. Do you expect that Republicans will sit on their hands when the president mentions this war of the allies?
Well, listen, the ambassador will be there sitting next to the First Lady, Oksana Makarova, as she did last year. Remember, last year, the speech was rewritten 6 days before it was given. Russia invaded Ukraine. So that is why it was really forefront last year. It is still going to be a major part of a theme this year, especially as this president is facing a divided Congress, and he's going to be leaning into especially these Republican senators that want to make sure they are continuing the aid to Ukraine. But as we've heard from a lot of House Republicans, they want more oversight on that money that is going and the weapons that is going to Ukraine. I don't think at a State of the Union there's going to be boos when this comes up, right? This is an incredibly sensitive, devastating time for people on the ground, especially with their ambassador there. But you make a good point, Tom. Really, the top two themes of this State of the Union is going to be the economy, and secondary, of course, is China. And that is because also China was front and center over the past 7 days. The speech has to really adapt to what's going on. I'm told that the economic portion, what the president will say regarding China, has not been changed by the balloon incident. But obviously, the president has to address the elephant in the room, which is the surveillance balloon.
So, Anne-Marie, we've seen the fact sheet. Within the fact sheet that was presented yesterday afternoon, when you worked through it, what's in there that you think can actually get done?
It's difficult because it's a divided Congress, and there's even things in that fact sheet the president talks about, like billionaires tax, but he wants to hike the tax for share buybacks. Those items, although the excise tax for share buybacks did get done at 1%, they want to quadruple it because they're not seeing it make any sort of an indent in companies. Those items, Jonathan, you mentioned earlier this morning, this was a Congress that could not even close the carried interest loophole. So they're agenda items that they could not get done when they had control of Congress. They're not going to get done now. I think when you honed in on things like bringing more manufacturing home, making more of what we use in America, these are going to be top themes. But also in the future, this is very hard to do when you have a very tight labor market.
What tea leaves are we going to get tonight in terms of the 2024 run for President Biden?
Well, this is his whole speech, right? It's making the case to the American people and to and to his own party that he should be the man to lead them into 2024. Not everyone in the Democratic Party is sold on this. So this is going to be one. President's going to come out and say the State of the Union, it is good. I'm optimistic. We have more work to do, but look where we are. We've come out of the pandemic. We've come out of the supply chain bottlenecks. We've been able to hold the force together in NATO when it comes to Russia's Ukraine war, and you have to give me 4 more years to keep doing this. That is going to be his message without actually saying, I'm going to run. And also, this is continuing all week. The president's going to be in Florida.
Oh, here we go.
Wisconsin.
We're making an extravaganza?
Well, yes, they're a huge extravaganza. They're doing a blitz across the country. We have Yellen going to Tennessee. Raimondo's coming to you in New York. They are going everywhere to tout the last 2 years and promote their next 4.
20 seconds. Bramo had the best insight of the morning on this. Is Biden speaking to centrist Democrats, or is he going to shift it to the progressives?
Centrist Democrats. He is going to, and this is what Brian Deese told us yesterday, he is going to make clear that the American people have spoken and they want to see Democrats and Republicans work together. At the same time, the president, I'm sure, is going to make sure that he is showing a divided look about how he wants to manage in a mature way and how there are members of the Republican Party that do not agree with that. He wants to make sure that he is painting himself different from the Republicans, but he's going to give an olive branch because he wants to work with his Congress, and he's going to have to if he wants to get anything done, including the looming debt ceiling.
MH, thank you.
Great summary.
As always, thank you very much. In that fact sheet, they talked about the deficit under the former president, Tom. I think pointing out that under Republicans...
that's part of the sport.
What direction it was going in?
I thought Anne-Marie gave for our international audience, she gave a great summary of the ballet that happens tonight. And she told me off camera, she says, the bottom line, I've been to it. I mean, I've been there, and it's this complete inside the Beltway nirvana. Does the rest of America really care about this speech? I'm not so sure.
Depends what's in it. We've got a decent idea of what's in it right now.
I think it's the drama of it. It's when they walk in and go, ladies and gentlemen, you know.
You know what I always wonder? Whether when people have to, like, stand... The party that is the same as the president has to stand and clap after everything that they say.
Right,
whether they're ever like tired and don't really understand and kind of
they
feel
probably
like
have had a
have
beverage
to.
of their
Sometimes
choice.
they stop listening. I mean, there's some great ones, and I won't point them out. There's some great ones where they say really serious stuff, and someone jumps up, smiling, and clapping. It's like, no, that wasn't the time.
Exactly, and everyone jumps up. Although people kind of all join with them because probably a lot of people aren't listening. It's just sort of the pageantry.
We got a problem.
What's that?
Really
Just one?
dovetails. April 5th,
Away
the
we go.
three of us,
Baseball.
spring training, Tampa, double barrel for team surveillance, Yankees, Phillies, and then we go see the Tampa Bay Lightning play the New York Rangers. It could be a surveillance-thon in Tampa.
Is that ice hockey?
That's ice hockey. Thank you. You'll
Wait,
like
do
it.
they have ice hockey in Tampa?
Yeah, thank you, Mr.
Always
Vinnick.
confused me.
I just
Mr.
always
Vinnick,
confused
Mr. Vinnick,
Always confused.
here's the
Not
path.
really.
Totally.
Jeff
I'm on board
Vinnick
with you.
did
On
well
the
at
same page.
Fidelity. Vinnick did well at Fidelity, went down and salvaged Tampa hockey. That's the history.
Thanks for that, Tom. It's important stuff.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
TK's trying to work out where he lives next. Are you done?
Our guest is just encyclopedic on this.
You're moving to
We're
Portugal
moving to Cuba.
now. To Cuba.
Cuba.
I thought it was Benfica.
on the way to Florida.
thought your team now was Benfica and you were moving to Portugal.
I am. Portugal's good. You know what happened here? This is true. Madonna, all of a sudden, it's like totally in the Iberian Peninsula.
Because of Madonna?
Yeah. Did you call Portugal the Iberian Peninsula?
You would.
You do. Okay, Portugal's part of Iberia.
Oh, I've got no idea where this is going.
Okay.
Commercial breaks
Good
here.
morning.
Chaos. Good morning.
It's not just a commercial break.
Positive 1/10 on the S&P. On the Nasdaq, up by about 1/3 of 1%. Last couple of days, pretty ugly stuff on the S&P, down about 1.6%. The Nasdaq 100 over the last 2 days, down about 2.6%. Just monster moves in the bond market. So let's pick up on that. On a 2-year, the 2-year last week, I think Friday morning, 4.09%, and now back to where we started the year on a 2-year at about 443 rather, at 443.30 on a 10-year 363. So you've got a 2-year, 10-year spread right now of about negative 80 basis points. Will that stick? Priya Misra says it will all year. Yield curve inversion throughout the whole time of 2023.
Or negative 80 basis points. And again, the first thing I did on a Monday, folks, you always look at that first Bloomberg chart. And for me, it was taking 2s out to 3 month. The T-bill that Lisa mentioned is really moving now. The 1-year lease is what, a 4-ish?
With 1 year is 4.8%.
4.8% on a 1-year T-bill. And then, John, you got to the 30-year benchmark, and you've got massive inversion if you look at the entirety of the yield curve.
When are the banks going to sort it out? When are the banks getting on board and jacking up rates?
Actually, they are suffering as a result because all of the deposits are going out. One of the fastest paces of
Why don't
deposits
they raise
getting withdrawn.
rates?
Well, this is going to be the pressure. What is the need for that cash if they're going to go to the Fed's fund rate?
Brian, I know you're listening. Brian Moynihan should come on surveillance and explain to us.
Tell us about interest rates.
Why
He
aren't
might
you
say you
raising
signed up for 0 interest rate accounts and you don't pay for that account, and this is part of the offering.
There was a long time where they had too much cash, where it was actually a liability. But at what point does it cross into they want the cash to attract the deposits? They got to jack up the
Tom's
interest
thinking, are the toasters coming back? Is that what you're thinking, Tom? Are the
Yeah, I
toasters
said that
making
to
a comeback?
Solomon once. I said, you want a Goldman Sachs solution for your bank, give out
For
toasters.
Marcus, give out toasters.
Yeah,
How does
he
that
said,
work?
well, he's going to call up Williams-Sonoma and find some $400 toaster.
You got to do like
and get it done.
AirPods or something.
AirPods,
Bring it,
toasters.
yeah.
What year is this?
Yeah.
Who eats bread anymore? People eat bread?
Yeah.
People eat bread.
I eat
Don't eat bread. Poisonous stuff. Euro dollar, 107. Had a look at 106 earlier on. Going to get so many comments on that. I know. 110.33. Tom Brady doesn't have bread, does he? 110.33 last week on euro
You're
dollar.
aspiring to be Tom Brady.
What greater man is there to aspire to be an American than Tom Brady?
I like bread, and I'm sorry. I'm not going to apologize for it, especially when it's fresh.
There you go.
Good. All right, so let's talk about some of the specific names that are moving this morning. Bed Bath & Beyond, Wedbush just downgraded it to $0 from $1 because they are possibly creating into bankruptcy, but they are coming up with this plan to possibly have some sort of financing situation to avoid Chapter 11. Those shares are responding by dropping by 30.4% as a response. Baidu, this is really interesting. The ADRs, the American Depository Receipts of this Chinese company, surging more than 13% because of their rival to ChatGPT. And this is all the rage. If you take a look at all of the tech companies, particularly in the US, the cloud computing units are teaming up with these artificial intelligence groups and trying to create their own robots that can replace us and all search engines and things
Stock
like
is
that.
up 86% since the lows of October.
It's just shocking to see some of
These
moves.
Chinese names have absolutely ripped, rocketed.
And you do wonder how much it is because of the reopening and how much it is because of certain kinds of revaluation, particularly within the tech space of ChatGPT and Pinterest. I know that Tom really likes this name in particular. He's been spending a lot of time on Pinterest to find out his travel wardrobe.
Are they still like a going concern? Are they still like doing well? Seriously?
They actually had some constructive earnings. They announced some fourth quarter earnings, but there was some concern. It was weaker than expected revenue. Analysts did feel like people were possibly engaging a bit more. It is a more female audience that tends to use this. But
what for? I still don't get it. What is it?
If you want to like decorate a room or get an idea for remodeling or decorate,
You make
know,
it-
a
they're mood boards.
scrapbook, and yeah,
They're
you
mood
kind of
boards.
get ideas from
I
it. That's the
tested
idea.
it years ago, and it just didn't work for what we're doing.
What were you doing?
I was just seeing if it would work for surveillance. Like I looked at TikTok the other day.
You
It
wanted to
doesn't
make
work.
a mood board for Pinterest.
I don't know.
Surveillance.
I didn't know. I interviewed Ben, And I said, okay, I'll look at it. I said to Ben, I'll look at it.
For what, the background?
I just, I was curious about Pinterest. And like you say, at the time, I don't know what it is now, it was all like, there was a wedding board. The divorce boards are good.
Going there. You brought up that, not me.
Just why would someone advertise on Pinterest rather than Meta or Google? That's
Are we done?
Yeah,
Main event, Chairman Powell, 12:30 Eastern time.
Well, this was the main event.
I'll get us out of this. Investors trying to work out the Fed's path ahead. Christina Campmany of Invesco, who I hope is still alongside us, wrote the following. Our base case for the Fed is they deliver an additional 25 basis points in March, bring Fed funds to 4.75 to 5%, with the risk of continuing, Tom, at a 25 basis point pace for one or two additional meetings. I think that's where a lot of the street are right now, TK, after payrolls on Friday.
Our heads are spinning. Invesco is such a big shop. And joining us now, Christina Campmany, Senior Portfolio Manager, Global Debt in Invesco. I'm going to assume you're not hanging on every word of the chairman today, but yet all of our heads, institutional and retail, our heads are spinning right now. How do we get control back of a thought process to the future?
I think that's right. I mean, obviously, we came off of a massive data week last week with the ECB, the Fed, the BOE, ISMs, HICP. I mean, this massive week. But it seemed that the market took away the narrative that it wanted to find rather than really listening to what all of these central bank speakers gave us. And I think if you look at the statements alone from all of these central banks, they lean hawkish, and that is not the market reaction that we got Wednesday, Thursday, and you've obviously seen a correction the next couple of days. But I think the Fed speak in the next couple of days, and Mary Daly's kind of echoed it, and you had Kashkari this morning, I think, say the same thing. And I think
yesterday.
Yeah, you're going to have this back and forth of where nobody said we're done, right? Like, we've made progress. I think Friday's payroll report is a fly in the ointment for them. Like, it doesn't give them the green light to just back off.
So the pushback might be on Wednesday. Chairman Powell said the disinflationary process has started. He was asked about financial conditions, which had eased markedly over the last couple of months, and said they haven't changed too much. Was that a mistake? What was he trying to tell us?
I think when he spoke, the one kind of nod he gave was more, it seemed to shift to a singular focus on inflation versus before it's really been the dual mandate of inflation and we need to control the labor market. And I still believe that they need to see both, but perhaps the inflation coming down, if we actually fulfill the market narrative and where we're pricing to get to this back to 2% target by June, perhaps that's sufficient for them to pause. I think where I have trouble with the market's pricing or in the market's narrative is about this turnaround easing in the second half of the year, even with a soft landing. Like, if the Fed navigates a soft landing, there's not a real aggressive case for them to ease.
That's a good point. So this is the pricing for Fed funds. Let's talk about market pricing and fixed income. Credit has rallied so hard. Lisa's talked about what's happened in investment grade, further down the quality spectrum to high yield as well. Do you move away from certain parts of credit now? It's rallied so much.
I think you do. And I think we've across, I think some of the easier trade of 2022 of a duration trade and directional has been taken off the table. In the last 2 days, we've done a lot of work to reprice off of the extreme richness in the treasury market, but I don't think it's a duration trade as much from here. So spreads are tight. The underlying health of the corporate sector remains strong, and global growth, if we take a step back, looks a lot better than we thought we would be 6 months ago. 6 months ago in the summer, we were talking about a massive energy crisis in Europe and a very deep recession. European growth has continued to impress to the upside. China reopening has come to the table sooner than we expected. So I think that there's a lot of positive momentum. But yeah, credit is less appealing of the options for us,
This is fascinating because it actually builds on what Daryl Cronk was saying of Wells Fargo, where he basically said that they had really done amazingly with the duration trade. He was talking about when they got in, but saying perhaps that's kind of over for now. He sees a range of 3.4 to 3.9% on the 10-year. Do you agree? Would you sell duration here and just go into some of the areas that aren't the barbell, which basically you're saying isn't going to work now?
Yeah, I think, look, the price action in the last 2 days, I guess today would be 3, takes the compelling we're way too rich on the spectrum off the table. But I think on the margin, yeah, duration isn't so compelling here. I think it's more of a curve trade. I appreciate Priya's argument on the curve, and she has been right, but I don't think that an inverted curve is sustainable in the long run, right? And I think that that's where the market will push back. But I think positioning in all of these markets continues to be a very large driving force. And you see it in equities, and you see it in foreign exchange the last couple of days, and you see it across the board. And I think, again, the price action on Thursday and reversal on Friday speaks to positioning and people capitulating out of things.
I got an email from Lisbon last night, and he said, my God, Christina's on Talk Benfica. John, at the World Cup, I don't know nothing, okay? And I'm rooting for France, and there's this kid on Argentina, Enzo Fernandez.
A midfielder, yeah.
Who's like, would you explain, I mean, we got the all-time Benfica fan ever with us from Invesco. Would you explain why Chelsea paid $100 million
He had a big buyout clause
for this piece of meat?
Had a big buyout clause, and
who is he?
Ultimately, that means if Benfica, even when they keep him, even if they wanted to keep him, if it's met, you meet the buyout clause, he's gone.
And
Came
he's
pretty
going
close.
to
Todd Bowley
Chelsea.
threw so much money. I mean, this is not a Benfica Enzo Fernandez issue. This is a Chelsea issue in the January transfer window where they spent something like $400 million.
Why are they
in a
different than
single
Man
month.
City?
Benfica?
No,
Or
Chelsea.
Oh, in
With all
terms of
this money.
where's the money come
Exactly.
from? That's going to be an important question.
Okay, I did okay there.
It's going to be an important question.
Okay. Okay. Would you like to join us in our soccer analysis?
I think
here?
she's going to take a pass.
Yeah, there may be a pass.
We don't have enough Iberian.
Like hard pass.
Benfica beat Braga the other night.
Is that right? Oh, you're really on top of this.
Really on top
Should
of
we
it.
send Tom to
He's
Lisbon?
preparing for his move to Lisbon.
Should we send Tom to Lisbon? Let's make that happen.
$100 million on a player?
I think that was sterling, actually. $100
Okay,
million
sterling.
Yeah, pound sterling.
He's that good. Is
He's
he
pretty
the new
decent.
Messi?
I don't know if
Messi plays for Argentina,
No,
right?
no, he's not. He does.
Okay,
Too many
thank you,
questions,
Dylan.
Tom. Messi does play for Argentina. No, he's not as good as Messi. I just think that transfer valuations for some of these players now has just gone insane.
Okay.
Insane. And unlike American sports, that's the fee for the club, Tom. That's not what the player gets.
Oh, I didn't know
So he's
that.
got to negotiate his salary separate.
Okay. Thank you for bringing this up.
Christina, thank you.
She
For the stuff on the markets.
Thank you. That was
Just didn't
great.
count money there of Invesco. Gerard Cassidy's going to join us shortly from RBC. That's up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Search and rescue crews from overseas are deploying in Turkey a day after a pair of powerful earthquakes left more than 4,000 people in the country and Syria dead. Turkey's defense minister said the military has started evacuating some of the injured via Navy ships. Millions have been suffering without power or heat in the cold. In the UK, Prime Minister Rishi Sunak has reshuffled his cabinet after a rocky first 100 days. Sunak broke up the sprawling department responsible for business, energy, and industrial strategy. He created a new department focused on energy security and another to deal with science, innovation, and technology. President Biden will call for quadrupling the levy on corporate stock buybacks. In tonight's State of the Union address, the president also will renew his plea for a minimum tax on billionaires. Neither of the proposals is likely to gain much support in Congress. SoftBank's Vision Fund reported another quarterly loss, its fourth in a row. Global tech investor lost $5 billion. A collapse in valuations last year pummeled Vision Fund, which holds stakes in hundreds of startups. And Disney has almost 2 months to convince investors it's on track and doesn't need activist investor Nelson Peltz on its board. The world's largest entertainment company scheduled its annual meeting for April 3rd. Peltz is trying to persuade large shareholders he has the experience to turn Disney around after its stock price floundered. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Moment news breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
We will have a couple of quarters, let's say, until the summer, that might be somewhat more impacted when it comes to growth. But after the summer, we anticipate it to pick up again. And so that basically means for a bank like BNP Paribas that's focused on institutionals, on corporates.
Last Masha now there, the BNP Paribas CFO catching up with Bloomberg a little bit earlier. Going into the opening bell about an hour and 45 minutes away. Equity futures positive, 0.1%. Yields basically unchanged, 363. Chairman Powell coming up later this afternoon, 12:30 Eastern time, after last Wednesday saying the disinflationary process has started, not pushing back against the easing of financial conditions. This market rallied hard on Wednesday, then bumped into a monster payrolls report. Tom, will Chairman Powell be any different today after seeing that report on Friday?
It's going to be interesting to see, John. And what do you think? I mean, let's talk about this for 2 seconds. The three of us here. Isn't all his radar up to say nothing and just get beyond this meeting with Mr.
Well, he's booked to say something.
I
do think, you know, watching David Rubenstein's style, it's unlikely to be the direct kind of questioning you'll get in the press conference with
He's not going to be rude like McKee, yeah.
Not at all. So we'll see how direct things get over things like financial conditions. But ultimately, Lisa's made this point a few times in the last couple of days. I think Lisa and I are totally on the same page. The market has adjusted to incoming information, which would suggest there isn't a problem with the interpretation of the Fed's reaction function. There just seems to be a disagreement over the forecast. If you catch up with a lot of economists who have got cuts priced in later this year, they see a softer growth profile and a quicker deceleration in inflation. The Federal Reserve clearly doesn't see the same thing.
Well, and just to give you a sense, just to build on that, Neil Kashkari was speaking this morning of the Minneapolis Federal Reserve, and he said, I too was surprised by the big jobs number. It tells me that so far we're not seeing much of an imprint of our tightening to date on the labor market. Do we get a reiteration of that from Chair Jay Powell?
Well, if they start to doubt the so-called cumulative tightening of the last year and the impact it may or may not have, Tom, in the coming months, that would be interesting. That would be interesting, and that would imply they've got a ton more work to do.
It's going to be interesting, and again, we'll have full coverage of this. John mentioning in the 12 o'clock hour, look for Jay Powell on Bloomberg, on radio and on television as well. This is a joy for us right now and a real symbol here, John, of everything to move beyond the pandemic. To have Gerard Cassidy with us remote from Maine, his legend at Tucker Anthony, for years and on to RBC Capital Markets, but to have him in studio, I think is a real hallmark.
I just realized it's been 3 years.
Yes, almost 3 years to the month.
When we last talked to you, a lobster roll in Maine cost $18. Now it's like a bottle of champagne. What happened?
Tom, rising costs. Even the lobstermen are facing higher inflation costs. Obviously, fuel, also labor costs are very high, and that's what's driving it.
And look at the real estate pricing us right out. Let's get to it right now. Gerard Cassidy, I'm going to look at securities analysis and the 4% return over the last 10 years I got with a dog like Citigroup versus the 14% return I got as Harrison passed off JP Morgan to James Dimon. That differential, how do you, with the legend that you are, how do you grind out not to pick the dogs in banking?
It's Very interesting, Tom, because it's all about execution, as you know, and obviously J.P. Morgan Chase has executed and Citigroup has not. And now, under the new leadership, Jane is trying to execute and divest many of the businesses outside the United States. Mexico is the big one. And I think if they get that done this quarter, that will help the stock.
We'll buy Mexican Citigroup banking. I mean, there's such an emotional lodestone there for the heritage of the company. Back to Mr. Reed.
No, you're quite right. Either a local bank or one of the Spanish banks are most likely to be the buyers, not an American bank, though.
Joe, as we reflect on the last decade or so, just how much more defensive are these names? How much have these banks actually changed?
John, that's really a good question, because we're going to find out. This is going to be the true test. If we do go through a recession and the banks have been de-risked because of the financial crisis and the stress tests they go through every year, this will prove, assuming they get through it without having a major earnings problem, assuming none of them cut their dividends, imagine what they're going to look like coming out of the next cycle if this all takes place, which is what we think could very well happen.
So what does that mean for how we should value some of these big banks?
There you go. So then do they become so-called financial utilities? So they'll never trade like Duke Energy, but should they trade at 8 to 10 times earnings? Maybe they get revalued to 12 to 13 times earnings. They'll never be market multiple stocks, of course. But the point is that we could have a revaluation coming out of this, whatever we're going into, a slowdown/recession, assuming the banks don't blow up like they did in, of course, 08-09.
So let's talk about one of their main utilities, which is a place to park cash, right, for consumers. Last year, in the second and third quarters, banks saw the biggest outflow of deposits on record going back to 1984. At what point do they have to start attracting deposits with higher rates?
It's really going to be the question in this high rate environment, but we have to remind ourselves, if you go back to 2019, the system had just over $13 trillion of deposits, and they were growing approximately $600 billion a year. Today, the system is closer to $18 trillion because of QE. So I would argue the banking system has over $3 trillion of deposits that shouldn't be there. So I think you're going to see the continued outflow because of QE as now is QT.
Well, another way to put this is, do they want these deposits? Are banks happy to see them go?
It's, in a way, I think they are, because, they don't want to lose the good core deposits like, Tom's account or something like that, of course. They will lose some of the hot money, and that's okay. But what's interesting is that the loan-to-deposit ratios are still very low. And so a normal loan-to-deposit ratio is over 90%, and the system today is under 70.
Can I digress here?
Oh, no, please.
This is a real hunk of history. This is a real hunk of history. You and I knew Brian Moynihan when he was unheard of at the Bank of Boston, long time ago.
Correct.
And you and I, every year, would go to the St. Patrick's Day party for the Irish banks. I remember sitting in one of their drunk fests on St. Patrick's Day, 400 or 500 people going, this is going to end ugly. You saw the collapse of the regional bank experience. Moynihan, and after Ken Lewis, helped pick up the pieces now. What's out there right now that's the same emotion that you and I felt on that St. Patrick's Day morning long ago?
Tom, we ask that question to ourselves all the time, because every cycle we've had something blow up. And one of the things that I find so amazing is Fed funds rates have gone from 0 to 25 basis points to 4 3/4, and there hasn't been any debacles yet.
Exactly. Where is it?
We're digging. We're turning over. We're turning over every rock we can. We do believe that loans to non-depository financial institutions could be the place where it blows up, meaning loans to private equity companies. That's where the valuations have come down dramatically.
Is Harvey Schwartz watching this?
There's going to be a conversation about private money.
No, this is, come on, this is
in a major way.
You're dead on.
We're looking, anytime you have rapid loan growth in a specific asset class, that's where we take our nose to, and we just haven't really seen that.
Wait, is this the question Powell asked Rubenstein today?
Is that the return? Are they going to do it back and forth? They're going to do it back and forth.
David, how about that loan deposit ratio?
How about financial conditions,
Jared, I've got about 60 seconds, Jared. I want to kind of fit this in. Bonuses and what's happening with pay. If these banks are going to become utilities, what does that mean for the pay of the people that work at these companies? Credit Suisse right now talking about delaying some bonuses for bankers. What's the message for maybe a group of college graduates that want to go into this industry? What's the message for them now?
The pay is still quite good, even though the pay has come down quite a bit, as you know, John. And we have to remember 2021 was all-time record years. So we're coming off a very high base. That being said, pay is not what it was, 12 or 18 months ago. But there's cycles, as we all know. And there will be a capital markets cycle. ECM will come back. IPOs will come back. And that's when the bonuses really do grow. So it's very cyclical.
Let's do this more often.
Oh, I'd love to.
I'm thrilled you brought 3 pounds of lobster.
I'm surprised Tom's not promoting the trip up to Maine.
Well,
do you want to fit that in?
No, we get that in, but Maine's weather's tough. We're going to go up to...
He doesn't like the weather, John. That's the reason why he hasn't
there's this
advocated
bed
for that
and breakfast in Bar Harbor.
You went on vacation there a couple of summers ago, didn't you?
Well, it was called a vacation. I took a 1-day sabbatical.
It was a 3-day weekend.
3-day weekend.
I remember
and
that.
We went up to Bar Harbor. We stopped in Portland, looked for Cassidy, and he was out in this 57-foot Hinckley picnic boat, picnicking at Portland Harbor. That Hinckley boat you've got is gorgeous.
I wish I had one, but they are gorgeous. I want to make that clear. I wish I had one. Those are great boats.
That's a hedge fund boat there.
Yes.
It's like you can go sideways in it.
Yeah.
You go sideways on it.
It's got little thrusters on the side.
You ever seen the Reaver boats in Lake Como?
I've heard of this, yeah.
That's a proper boat.
Yeah.
That's a beautiful boat.
We didn't
more
talk
of
soccer
a,
with
more of a
Gerard.
lake kind of guy than I would be on the open waters.
Yeah, that's the way I am
something
too,
a bit,
I'm a putt-putt kind of girl.
just something a bit calmer. Joe, this was great.
Thank you.
Thanks for being with us.
I
Joe
really
Cassidy there
appreciate it.
of RBC. Coming up on the programme, Megan Horniman, Chief Investment Officer at Verdance Capital Advisors. She'll be joining us shortly as Chairman Powell gets set to speak at 12:30 Eastern Time, and the President of the United States to address the nation in a State of the Union address later this evening.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
The complicity of the international finance institutions, including particularly Goldman Sachs, is there. Otherwise, one MDB wouldn't have happened. You can't just get away and by ignoring your moral responsibility. And I think Goldman Sachs should come out clean and deal with Malaysia.
What do you like most about your job?
I think the people. Ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Double-dip recession is most likely what we're going to see over the next few years.
Some of the technicians I respect think they've seen enough to call this a new bull market. I don't.
The direction of travel for me is still very clear. We're not done. The terminal rate has not been hit.
My read of the data, the inflation data looks still primed to come down.
Of course, there can be huge revisions one month to the next in the data, so I'd be tempted to sit back. Let's see what happens over the next month or so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Thank you for joining us. A long day for Bloomberg television and radio from here to the State of the Union this evening. And John, the president confronts a phenomenal labor economy by the report that we just saw, and also a volatility in the bond market that is jaw-dropping.
So the labor market changed a lot on Friday. Just to see that report, I think it changed a lot for Fed Chair Jay Powell. It certainly meant that the speech writers for the president could edit the speech on the labor market. Look, we've got unemployment at the lows we haven't seen since the 1960s, and wages didn't accelerate.
Exactly.
So I don't want to run away with this story that this is absolutely terrible for the Federal Reserve and they have to rip up the script and go even further. We'll see. I think what's remarkable about this moment is our lack of understanding about this labor market at the moment, Tom. To see it drop to 3.4%, to see payrolls growth of 500,000, and to see wage growth just kind of not pick up in any material way. Let's see how that one
And part of it won't
develops.
be addressed at the State of the Union, but the financialization of the American debate of the elite. And you see it, John, within where we link equities, bonds, currencies, commodities. As an equity guy, I'm riveted on the signals, the tea leaves of the bond market. I don't know what to make of it into this eventful day.
Higher terminal rates, a higher peak rate for the Federal Reserve. But still, thinking about rate cuts at the back end.
Oh, come on, I don't buy that.
23.
I don't buy that.
It's in market
That's
pricing.
new.
It's not for me to sell.
Fair.
It is what it is.
It is. It's in the market pricing. But Lisa, you go to the terminal rate that John mentions, the rate that's out there somewhere. And then it's this new idea that we're going to sustain at that terminal rate for a long time. We need to get used to that.
So given that backdrop, which is what currently the market is getting used to, with a 5.1% terminal rate getting priced into Fed funds futures, there's counter-programming going on this afternoon and this evening, with Jay Powell on one hand talking about a jobs report that perhaps creates a fly in the ointment, as we heard just earlier, versus President Biden, who's using this as the pitch for his re-election campaign. So something has to give. Is this sustainable or isn't it? And it really speaks to what John was talking about, Tom, this mystery underpinning the labor market.
That was Darryl Cronk's point.
Yep.
As well, ultimately, you're going to see two different ways of thinking about the same thing. The labor market, it's great for the president. Let's see if it's problematic for the Federal Reserve.
Well, let's go. The Federal Reserve is at 12 noon, 6, 7, 8 hours before we hear the State of the Union. And John, we've gone round trip, essentially. We went from the Fed statement to me was not a shock. That's not accurate. The press conference was a shock.
I'm still trying to work out the
Huge
presser.
moves. And to be clear, for those not keeping score at home, was 1-0. Tottenham beat the evil people from Man City. But they rebounded. The bond market came back quickly.
Can I just say, Christina Campmany addressed this, and I liked what she said, which is basically the market heard what it wanted to hear. It was a lot of positioning. It was a lot of flows. Was it that shocking of a press conference? Disinflation was a word that he used. The market took it, ran really fast to a place that was stopping out shorts.
Things have changed for Chairman Powell. And I will repeat this and for however many times we talk about it. You had the Jackson Hole speech at the end of August where you're going to see some pain. It was blunt. It was 8 minutes. We've got to do this. He talked a lot about how the risk of doing too little outweighed the risk of doing too much. That was the next press conference from Chairman Powell. Then all of a sudden came the Brookings conversation around December time, where he started to sound a little bit more balanced, about the risks around policy, doing too little versus doing too much. We arrive in this news conference and he's talking about the disinflationary process beginning. I'm interested in the changes through the several months of hearing Chairman Powell speak. I'm not interested in the consistent message, which is we've got to stay on theme, we've got more to do, our work is not done. If you're in the market, you're focused on change, and there has been a change from Chairman Powell.
I've been remiss in not bringing this up. Paul Krugman, the laureate writing in the New York Times, was brilliant on, is this a 70s inflation of persistence and crisis, or do we go back to what's called the Korean analog of the two bouts of sharp disinflation? And he's saying he really doesn't know. This is Krugman, but he's saying nobody's tilting towards the disinflation that Ed Hyman's talking about.
I'll give you two answers. One, I personally don't know, for whatever that's worth. Two, this market, on aggregate, has made a decision that inflation will fade quickly and the cuts will come. Now, the question you've got to ask about the cuts, though, because it's a little bit more nuanced than that, are the cuts in Fed funds because you believe there will be a deceleration in inflation, which means monetary policy ultimately is too tight, or will the cuts be there because we're going to get this real roll-off in economic growth? And I think those two things are different, because if I'm long risk assets on this idea that I get cuts in the future, well, I think cuts in the future on growth collapsing isn't actually bullish. I think cuts in the future because inflation is coming down quicker than anticipated, that's pretty good news. They're not the same thing.
And this is what Christina Campmany was also talking about in terms of, can you price in rate cuts and a soft landing at the same time?
I mean, I look at it, and again, I think the thing we haven't talked enough about, we'll get to this through the hour and frankly through the week, is Lisa's observation on where Treasury bills are trading. John, to get the data check starting here, I'm just going to look at an equity market that's not in sync with the bond market. Equities flat, bonds moving.
Equities up 0.1%, yields down about a basis point, but a big move over the last couple of days on a two-year yield. On a two-year now through 440, on a 10-year back through 360, and the difference between the two, Tom, still negative, about 80 basis points.
Joining us now, Megan Horniman, Chief Investment Officer, Verdance Capital Advisors. Megan, thank you so much for joining. You're whiplash like we are. Have you changed asset allocation at Verdance off of the tumultuous week seen last week?
No, not yet. Actually, we came into the year, we raised a bit of cash in our portfolios because we thought that rally you saw in the end of 2022 was getting way too ahead of itself at pricing in what you guys have been discussing, rate cuts as a possibility this year. We do not see that as a possibility. I think the labor market data we got last week, confirms that. What a lot of people are talking about is that unemployment rate, but the one thing that is not getting a lot of attention is that job posting number. So we've had some consistent moves lower in job postings, and then last week we saw that number move higher. So we still do have tightness in the labor market. We don't think that's going to keep the Fed's foot off the pedal, and I think what you're seeing now is just some repricing of expectations for what can be rate hikes this year, and we just don't see that on the table.
Megan, I forgive you for saying last year, because it feels like every week has been a year, frankly, so far in 2023. With such whipsawing, how do you position then, if you talk about taking risk off the table? Where is the risk when you think of duration and how much it's already rallied? Is that at this point a risky place?
I think duration is a very risky place. This is one of the many things in the market that doesn't really make a ton of sense. When you look at the inflation environment, when you look at what the Fed's doing, the long end of the curve just hasn't really risen to a level that we think it should be. I mean, being below 4% on a 10-year, when you're looking at this environment, that's basically pricing in much weaker long-term growth prospects, but it's not pricing in the expectation for further Fed rate hikes into the rest of this year, and that's something that we expect. So we're staying short duration, stay in that, very short maturing bonds. There will be opportunity, we think, at some point this year to probably extend out that duration a bit. We just don't think we're there yet.
Are you listening to Fed Chair Jay Powell, or are you listening to the data and basically saying right now Chair Powell is just going to respond the same way that the market will?
Obviously, the market's going to move on Jay Powell's comments. That it always does. But we're looking beyond that, and we're looking at the economic data. What the economic data is showing us is we still do have an inflation issue. We're actually looking at CPI next week after a negative print last month that may actually show an increase of I think 0.5% is what they're looking for at this point. So I think when you look at the economic data, we've got to focus on what is the economy doing, how fast are we slowing. There's some areas of the economy that are really, really slowing pretty quickly. You look at the consumer, housing, manufacturing, these are all weakening at a pretty rapid clip. The inflation story we think will eventually get better, but right now this labor market just continues to be stubbornly, a stubborn kind of nuisance here for the Fed.
Megan Horniman, thank you. And thanks for teasing CPI next week. I was just looking at the estimates for the first time as well at Verdant's Capital Advisors. I can go through those estimates for you. Morgan Stanley at 0.4% month-over-month headline. Brett Ryan over at Deutsche Bank looking for 0.5%. Stephen Stanley, good friend of this program over the years, looking for 0.5% as well. Not all the estimates are in just yet, but our median estimate of a small survey pool is about 0.5% month on month. You strip out energy and food, that's about 0.4. And if you want the headline year over year stuff, whatever that's worth, Tom, looking for that to fall from 6.5 to 6.2, and for core to go from 5.7 to 5.5.
As we get closer, I'll get this out on Twitter. I'm so glad you mentioned it, John, because Bloomberg does a terrific, I'm not big on bar charts, except here it really, really, really works on the components of inflation. As you say, John, it's amazing the energy effect back to last summer. In food, I did not know this. Thank you to our terminal team for doing this. Food's become really pretty teens weens in terms of price change.
The base effects are going to be part of the story, Tom, for the year-over-year stuff.
Fair.
Who was it that said earlier, who was it that came on the programme and said you need to look at the month-over-month? Who was that? They were on the programme in the last couple of hours.
We got a number
Who was that?
We had a number of people who spoke.
And they said, look at the 3-month move. Daryl Cronk, I think it was.
I think it was
He
Daryl
said,
Cronk.
look at the 3-month average right now. We're almost there. Which is why he thinks we get the deceleration and ultimately thinks we get the cuts. Thanks for helping out, guys.
Anytime. I'm glad that we could help you with your train of thought, which none at all. No, this to me, though, is a real issue because Daryl Cronk also was saying when you get down to 3%, then what, right? And then all of a sudden the year over year isn't such a difficult comp. And that, I think, really is what people are grappling with. It isn't necessarily the disinflation that Jay Powell was talking about. It's what happens when it stops.
This is where we're going. It's called 3-month annualize, as Daryl alluded to, and John, you just nailed it. You take 90 days of data, and then you annualize it. That used to be a convention years ago. We sort of got away from it. I wonder if that's what we look forward to this year.
How tempted would you be to do that after that payrolls report we saw?
I was about to say.
No, there's a real mystery out there. Some people say it was a fluke. I'm not there.
We'll see at the next one, I guess. Difficult stuff, but certainly a better story for the President of the United States to tell when he delivers his State of the Union address.
He'll take 1 month
later on
annualized
this evening. I'd like to share with you the 3-month annualized inflation. Can you imagine the Republicans, McCarthy, ripping up the speech, going nuts at the back? What are you talking about?
Too much math.
Headline year over year, the changing of rules, equity futures unchanged. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The death toll from those powerful earthquakes that struck Turkey and Syria has now topped 5,000. Rescue crews are still searching through the ruins of thousands of buildings looking for survivors. Turkey's President Recep Tayyip Erdogan has declared an emergency rule in 10 of the country's provinces. The U.S. has begun to recover some parts from that Chinese balloon that was shot down off the coast of South Carolina. The military says one concern for recovery teams is whether the equipment carried explosives or other hazardous materials. China has made a formal diplomatic protest over the balloon being shot down. Minneapolis Fed President Neil Kashkari says January's strong jobs report shows the Fed needs to keep raising interest rates. Kashkari told CNBC he thinks the Fed funds rate will end up going to 5.4%. In December, Fed officials projected a 5.1% rate this year. Investors who lost money in last month's malfunction of the New York Stock Exchange can recoup all their losses, but that's only if their trades fit certain parameters. The rest may end up with nothing. Bloomberg's learned the exchange will cover all losses for orders routed to NYSE, but loss-making trades triggered on other venues won't be covered. And it appears that Bed Bath & Beyond will be able to avert bankruptcy. Bloomberg reports the home goods chain has lined up investors for an 11th hour cash infusion. The company plans to issue convertible preferred securities in a deal that would ultimately raise more than $1 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
your accounting was next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make?
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Today, President Joe Biden delivers the State of the Union address. Join David Weston and Bloomberg's top political reporters and analysts live from the Bloomberg headquarters in Washington, D.C. as President Biden lays out his plans to tackle the war in Ukraine, Congress's debt limit standoff, immigration, and more. And stay tuned after the speech as we break down the Republican response. Special coverage starts at 8:30 p.m. Eastern, simulcast on television and radio, only on Bloomberg, your global business authority.
Our national debt is high, too high. And the problem is getting worse, not better. We can have reckless spending, or we can have responsibility. We cannot have both. A responsible debt limit increase that begins to eliminate wasteful Washington spending and puts us on a path towards a balanced budget is not only the right place to start, it's the only place to start.
House Speaker Kevin McCarthy, the President of the United States, later on this evening, Tom, will have his opportunity to put his case forward.
Absolutely, textbook, John. You laughed at me last time I brought this up, and I don't know if there's a translation to other nations. You got to be clear here that tonight, when he talks about the debt ceiling, there's going to be a moral message from mostly Republicans as a Speaker of the House. This is a heritage item for a certain kind of Republican. You can call it John Kelvin 101. It's a morality about the debt and the deficit as it moves ever higher over decades.
Would you like an idea, a clue? Maybe a sneak peek of the address from the president a little bit later.
Please.
In that fact sheet they put out yesterday, there's a section on all of this, and it reads as follows. He will emphasize that his economic strategy has been a fiscally responsible one. President Biden's predecessor passed a nearly $2 trillion unpaid for tax cut with benefits skewed to the wealthy and large corporations, and the deficit went up, Lisa, every single year under his watch. I imagine that might come up in some way, shape, or form a little bit later.
There's sort of the parody of what this all boils down to, which is that Republicans want to paint the Democrats as giving candy to everybody and saying eat however much you want, and the Democrats want to paint the Republicans as not supporting infrastructure, not supporting fiscal spending, and also just sort of being hypocritical. On both sides, the problem that I see, and I'm curious about, is where is the middle going to be to get anything done and to actually progress forward at a time when you see a real push toward the center from both parties, frankly.
Good politics, Tom, not necessarily good policy.
Well, we're going to have to see it as well. There's a monograph on this, John, from years ago. We're going to go to the guest who's absolutely perfect for this discussion. Folks, Robert Heilbronner, and Peter Bernstein of the New School of Social Research stopped economic traffic a good 30 years ago when they wrote a monograph called The Debt and the Deficit. Henrietta Trays joins us right now, Director of Economic Policy, Veda Partners, here on what we just heard from the Speaker of the House. Henrietta, I want to talk about the moral overlay, the moral politics of OMG, we're in debt. OMG, we have a deficit. Heilbronner and Bernstein wrote brilliantly about this 2 lifetimes ago. What's the moral debate in the Congress you know so well about our debt and about our deficit?
It's a great question. And you mentioned heritage before. I kind of want to segue into that a little bit. The Heritage Foundation, which is a linchpin of the sort of Republican morality component, as you're referencing, is actually just embarking on a study to figure out exactly how much defense spending Republicans can cut right now in order to balance the budget. It's this tremendous morality question that's not just Democrat versus Republican, but also Republicans within their own party. Are we a party that is trying to reduce domestic spending and increase defense spending? Do we want to keep them at parity? The Heritage Foundation is about to launch into an investigation into seeing where the Pentagon can cut, where the Defense Department can cut. And that is a pretty unique segue for the Republican Party we haven't seen in as long as I've been alive, for sure. So I think that there's a lot of soul searching from both sides right now, and especially from Republicans before they even enter into conversations with Democrats about what to do about this.
To the memory of Pete Peterson, Tsongas of Massachusetts, and the others, Sam Nunn, I'll even put in here, that fought about the debt and the deficit. Where do, as President Trump would call them, Republicans in name only stand? Where is the moral fiscal politics of the middle ground of Republicans and Democrats?
I'll answer your question in two phases. One, I think there's a middle ground that is achievable. That is about $300 billion in fraud, waste, and abuse trimming. That's a drop in the bucket compared to the debt ceiling, which is currently $31.381 trillion. It needs to get raised to at least, 33 trillion to get to the 2024 presidential election. So that's your moral, middle ground that's achievable. But then you have Republicans that I think they would call them rhinos, certainly members that they have tried this before. They want to do things like tether the spending cuts to the debt ceiling hike on a 1-to-1 ratio. So using the numbers I just relayed, you're looking at cutting $1 trillion at a minimum from federal spending without touching Social Security, without touching Medicare, without touching defense, to get you 218 votes in the House and 60 in the Senate. It's unworkable. Then there's an even more impossible theory where you try to tether the debt to GDP ratio, and if you get or exceed a certain amount, you trigger automatic cuts. The current debt to GDP ratio is 124%. They've never been able to identify a ratio that they're comfortable with. And they've certainly never been able to identify an automatic trigger of what gets cut in the event you exceed that. So there really is no middle ground.
And Lisa, what's so important about what you just heard there on 124%, which I was shocked by, there's a lot of people in that room tonight that think we're on the edge of France. That's what this is really about.
Or that's some of the messaging that we may hear after the State of the Union. I am curious, just to pivot a little bit, Henrietta, not only domestic but internationally, what you're looking for when it comes to China and what President Biden's response is to the latest increase in tensions.
That's a great question. There's going to be no fewer than 3 hearings today on the House and Senate side, starting at 10 a.m., along with briefings of the Gang of Eight around the sort of spy balloon fiasco over the weekend. I think that what we've heard consistently from everyone from, former Ambassador Tai at USTR, even going so far back as when she was chief of staff on the trade subcommittee, is this is an area where you can actually get agreement from Democrats and Republicans, especially heading into the 2024 presidential. We're going to see Republicans and Democrats race to out-hawk each other. So one of the things I'm focusing on for investors right now is what that means for potential additional sanctions, what that means in terms of Treasury auditing the financial services industry in China, what it means for a potential ban on TikTok. I think all those things are on the table and will be at a minimum headline risk for investors and probably very real prospects as we head into the next 2 years.
Henrietta, just quickly here, what does that mean for large international companies based in the U.S. who are betting on China's rebound to really help juice their profits?
You got to really be careful about which sector you're looking at, because they're going to be obviously those macroeconomic headwinds that benefit them just from the reopening prospect and the sort of fundamentals. But you must layer on the risk of federal intervention from the United States, either through CFIUS, Treasury, the Pentagon, congressional action. Those risks are very real and present. I think the semiconductor and the battery space would tell you that in a very clear recent illustration. And you've got to be able to understand that the American administration is ready, willing, and able and thoroughly prepared to maintain existing tariffs, ratchet up existing tariffs. We just saw the 200% tariffs on Russian aluminum floated yesterday. Those are all the kinds of things that we should expect for the foreseeable future, and probably at greater instances or frequency going into the presidential in 2024.
I've got 30 seconds left. Henrietta, when does President announce he's running for 24? When do we get that announcement from Biden?
This is the second time you've asked me that, so let's see if I can actually get it right this time. My understanding is that it is coming in the next couple of weeks, at the latest, maybe a month or two from now. Okay. We're going to get Nikki Haley announcing next week, and then more in May from the Republican side.
There we go. Henrietta Trace of Fader Partners.
Just lights out.
Next couple of weeks. One of the best also.
She's just awesome. Awesome.
How did the Republicans defeat the former president in the primaries, Tom? If you get a big field, Haley, Pompeo,
well,
DeSantis.
This is an overwhelming
maybe
question,
some others too.
and frankly, an overwhelming question of American history. And I don't have an answer other than I think a lot of Americans, and I mean this Republican, Democrat, are looking at our, what's the right word, Lisa, gerontology? Our aged politics.
Why are you putting this in my mouth?
No, but I don't know. The aged politics, John, of America. It's not like this in Britain, is it?
Well, no, I'm just saying that because I think you have to work out pretty quickly who you want to coalesce around in the Republican primaries. Otherwise, you get too far down the road.
Yeah,
and,
they get some months here, but
the former
14
president runs
people
away
will
with
run
it.
in, Mike Pompeo, the rest. But
Potentially.
this is about the ancientness of American politics. It's absurd.
You want to go there, don't you?
It's absurd.
Things you can talk about, things that you know, Tom. Yes, Tom.
You always
yes.
ask me these.
Yes, of course.
I never ask you questions like this.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance, you've been talking about the debt ceiling, the deficit, and all that. Well, there's another deficit, too. There are twin deficits, and part of that is the trade balance. It is pandemic influence. It's been amazing, the expansion that we've seen in the trade balance. And one symbol of a recovering America has been clearly what we've seen improve. At least it's been amazing to see the recovery in the trade balance.
Well, a greater deficit, right? And we just got those numbers, a $67.4 billion deficit, a decline from the prior $61.5 billion.
Number, yeah.
But to me, this really shows the importance of the relationship between the U.S. and China. We talk about not having certain businesses, but trade is actually coming back and roaring back to the same degree that it was pre-pandemic.
To fit this into the math and to get to Mr. Powell here in the 12 noonish hour, Michael McKee in Washington. Michael, explain why the trade balance matters.
Well, the trade balance is a component of GDP, and when we have a wider trade balance, it subtracts from GDP. And at this point, it looks like we are widening a little bit. Now, the question we have to look at is why? Is it because we're exporting more, or is it because we're exporting less? That's the real question. And a lot of this has to do with the strength of the dollar as well. It's been a long time since the dollar started weakening, and we should start seeing some of the effects of that by U.S. exports rising a little bit more. But it is a component of GDP, and it was a component of GDP in the fourth quarter, because these are December numbers. So a stronger number, a strong fourth quarter, maybe a little bit weaker because the trade deficit is a little bit wider.
This number doesn't necessarily move the needle like the one that we got on Friday, which definitely changed the narrative in a meaningful way, particularly for Fed watchers. What are you expecting to hear from Fed Chair Jay Powell today, starting at 12:30 p.m. Eastern, when he addresses the reaction in markets and then the subsequent labor market report that was, to quote Tom, better than good?
Well, Jay Powell is a dignified public servant, and I don't think he'll stand up and say, yeah, I was right. But basically, that's going to be the message. The Fed is going to raise interest rates. The Fed is going to keep interest rates high. The Fed sees a much rockier path to 2% inflation and a soft landing than the markets have. And now the markets seem to be coming around to that view. So I think Powell will have, this is an hour-long question session about the Fed and what they do, but I think the message he will walk in with, already prepared, is we're going to stay the course. And that's the thing he will want people to take away from today.
Help me with Michigan on, I believe it's Friday, on February 10th as well. Will there be value, Michael McKee, to the Michigan Confidence Series, plural?
Well, there's a little bit of value in the Michigan numbers on inflation. If people think inflation is still coming down, then that helps the Fed's case for getting to 2%. It is opinion-based in large measure on gasoline prices. So if gas prices hang in there, they've gone up a little bit, but if they hang in there at lower levels, it should continue to improve. Then the question is, what do people think of the economy? There isn't a direct link between the confidence numbers and spending, but there's an implied link. It's more coincident than anything else. And so if we see people getting more confident in the economy, then that suggests that maybe a recession's a little bit farther away.
Michael McKee, thank you so much again with Chairman Powell and David Rubenstein in the 12 noon hour today in Washington. To another Michael now, Michael Darda joins us, Chief Economist, Roth MKM. Michael Darda, good morning to you. I thought Krugman was brilliant, the Nobel laureate. I know you and Paul Krugman are always on the same page. And he said, look, there's a battle here about, is it 70s inflation or is it Korean War inflation, where we went up and then we came down? Which is it? Are we back to 50, 51 and on to the true Eisenhower deflation, or is this a more real, tangible, persistent, higher inflation?
Tom, I don't think it's either one. I think this was a Milton Friedman money supply aided by fiscal policy, monetary inflation, essentially a one-time shot that's now reversed. You could see it in the explosion of broad money that never happened in the last business cycle. The Fed ignored it. You could see it when the residential real estate sector took off like a rocket. Fed ignored it, and nominal GDP booming at a double-digit annualized pace on average. 20 quarters of recovery. So that's the inflation. But it really started to reverse course at the end of last year. Nominal spending growth for the domestic private sector was under 4%. So if that persists, then this inflation problem is going to go away over time. And the figures have been exceptionally weak. So if that's your framework, a more monetarist framework, I think you're optimistic about inflation coming down. If you're in a Phillips curve slack-based framework like Krugman and most of the FOMC, then you're probably more pessimistic about the inflation.
Michael, I look at Olivier Blanchard's new wonderful monograph, probably my book of the summer. I'm not there yet. And Professor Blanchard talks about the Biden stimulus. Are we still in the Biden stimulus as he speaks to the nation tonight?
Well, Tom, really the Fed determines that with their monetary stance. So they're going to take the fiscal policy that's given to them, the Fed's rapid adjustment in short-term interest rates last year, and that's ongoing. They're going to continue, but just at a slower pace. And the ongoing quantitative tightening that'll continue in the background, I think is fully offset any additional fiscal tailwinds that are out there. So the Fed can always offset a fiscal impulse over time by adjusting its monetary stance, and that's what's happening. What is the Fed telling us? The reaction and function is get to restrictive and then hold there so that growth is below trend. That's how the Fed believes inflation is going to come down. So when we get hot data like we did for January on the ISM services and the employment report, which was shocking and jaw-dropping, that is simply going to reinforce the Fed's resolve. They will slow this economy, probably put us into recession most likely. And if the data surprises, you're just going to get a more hawkish Fed. So we're kind of in a damned if you do, damned if you don't part of the cycle.
Shocking and jaw-dropping. Some people say hard to believe in terms of the labor market report that we got on Friday. How many people called you up and said, you really buy that?
A lot of my clients said, that they thought something was fishy. I mean, it's really hard to explain those numbers. I mean, conspiracy theories aside, we'll have to see whether those data are revised, whether it was just a flash in the pan. You know, what we know is last year, domestic real final sales to the private sector were up less than 1%, barely 1%. And that leads employment growth by a quarter. So, these figures didn't really make a lot of sense. Either the economy is just suddenly accelerating, which is going to force the Fed to tighten a lot more, or these figures are more of a flash in the pan and we'll see, weakness reassert itself as the year unfolds. And that, I think, is the most likely scenario if you believe the leading indicators over coincident and lagging information.
Mike, you said that you think that a recession is a likelihood, despite a lot more people talking about it becoming less and less likely, or a no landing type of scenario, to quote Torsten Slock over at Apollo. Do you think that the idea of rate cuts are incoherent with a soft landing, are incoherent with this no landing type of situation? Because both are currently being priced into the market.
Yeah, that's a really good question. So I don't think you're going to have any Fed rate cuts unless growth is pretty weak. And these lagging indicators of price level pressures, the services, CPI and PCE components tend to be pretty backward looking. The Fed really wants to see a lot more weakness there before it relents. So the setup for rate cuts in the back half of the year is a dramatically weaker economy. If that doesn't happen, the Fed's just going to continue tightening until the economy weakens. So that reaction function is really not a soft landing reaction function. So I think investors have to be a little bit careful here, because the S&P 500 was just up at 18.5 times forward but falling earnings estimates. That's a soft landing scenario that's priced in, and I don't think the Fed is really to allow that with its reaction function.
So let's piece three things together here, Michael, so we'll be sure you return to talk to us again. I want to look at nominal GDP, the animal spirit of the economy, but I want to fold it into an analysis of the dynamics of the inflation-adjusted interest rate and the real growth rate of America, R minus G. I mean, this is just classic boilerplate economics. That's a real wide set of dynamics. What should our listeners and viewers focus on in R minus G and the animal spirit of Joe Biden's nation?
So the first thing that we can focus on is just, what has nominal GDP done throughout this recovery, and does it explain inflation? And what it's done is advance at a double-digit annualized pace. Go back in look at any business cycle, nominal spending that strong is associated with elevated inflation. So the Phillips curve models didn't really capture that. What we saw at the end of the last year was nominal spending slowing dramatically back to trend, just under 4% if we look at private sector final sales in nominal terms. That's less than the average of the last cycle, where we were just over 4, and that was associated with sub 2% inflation. So total nominal spending equals aggregate demand, and if that softens in a sustainable fashion, then inflation is going to come down. But inflation does tend to lag the business cycle. So right now we're seeing more weakness in real versus nominal variables. But the Fed rate hikes, the balance sheet contraction, the weakness in broad money, this persistent and deep yield curve inversion, the previous 7-quarter recession in residential real estate, those are all leading indicators of much slower growth and more likely recession.
Michael
We're
Darden.
not
A clinic. We got to leave it there. But Michael Darda, thank you so much. He's with Roth MKM. And Lisa, I think that really goes to some of the observations you've had here on the leads and the lags here. I thought he beautifully explained on a path of his belief of what we're getting to in late summer, early fall.
The damned if you do, damned if you don't idea was really popular at the end of last year. Sort of good news is bad news is good news. I know how much you love that. But, we're not really seeing that as much. We haven't over the past couple of months. We're reverting back to that now, given this labor market report that people are not treating as a flash in the pan, including Fed officials.
Well, to me, and it's the inflation debate. I mean, some of it, not to make a joke about transitory, but there's all this other mumble jumble, and all we can do is grab onto things that matter. And change of price is something within all its complexity that we can actually grab onto. And I'm taken by people like Mr. Darda, Mr. Hyman, and others that are modeling out sub 3% inflation. I don't think a huge body of the street believes that.
Well, and what does that do to corporate earnings? You talked about the disinflation in food. Tyson, did you see Tyson and the chicken prices and how that actually gave them worse earnings and a disappointment? I mean, it's a really complicated kind of equation.
We'll continue the complication. Peter Cheer to join us here in a moment. Chairman Powell to join us at 12 noon, and you across this nation. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Search and rescue crews from overseas are deploying in Turkey a day after a pair of powerful earthquakes left more than 5,000 people in the country and Syria dead. Turkey's defense ministry said the military has started evacuating some of the injured via Navy ships. Millions have been suffering without power or heat in the cold. President Biden delivers his State of the Union address tonight against the backdrop of two big issues. Tensions with China are rising, and there's a brewing showdown with House Republicans over raising the debt limit. The president is expected to highlight the accomplishments of his first 2 years in office and lay out his vision for the next year. Hertz has posted fourth-quarter profit that beat estimates. The rental car company says that corporate leisure travel are both on the rise, but falling used car prices, it played a part in profits, declining 45% from a year earlier. BP has joined other giant energy companies in posting a record profit for 2022. The UK company reported earnings of more than $27.6 billion for the year. Now shareholders will reap the benefits. BP is boosting its dividend and will buy back an extra $2.7 billion of shares. And an unpleasant surprise for some bankers at Credit Suisse. The struggling Swiss lender is delaying much-anticipated bonus talks that had been set for today. Bloomberg's learned the talks may be rescheduled in the coming weeks. Credit Suisse would normally pay the annual bonuses at the end of February. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think the next big risk is recessions that are deeper and longer than what we've been accustomed to. Every time the economy slows, it'll be painful because central banks will want to ease and at the same time will be struggling with how sticky inflation has been, and that'll be exacerbated by the political situation.
Newly minted CIO at Bridgewater, Karen Carniel-Tamber, they're in conversation with Shanali Basak. Look for this conversation. You can see this, the big risk, it's going to be tomorrow night, 9:30 p.m. As well. We're looking forward to that tomorrow night. Henry McVeigh will be there, which is a good and beautiful thing. He's got some real experience in the ups and downs. We're waiting for Chairman Powell at 12 noon. Bond market moving. I look at the 2-year yield, and Lisa, I would say at 4.45%, and I think it was near a 3.99% 2 cups of coffee ago. My only analysis is Peter Cheer is aged. I mean, that's the only place I can get.
I think a lot of people have. And there are two things that we heard from all of our guests. One of them is, has the rally and duration already been completely overdone? And basically, do you need to pare back? That's been one thing. And the other one has been a real bearishness on tech names. And Peter Scheer has a view on that, which I think is going to be interesting to hear, considering that is some of the big questions heading into the rest of the year.
Yeah, I mean, there's no question about it. Why don't you bring in Mr. Cheer right now?
Mr. Scheer, head of macro strategy at Academy Securities. So let's talk with that, given that duration has been really the big bet for the past couple of months. Is it time to kind of give that a rest? And do you see 10-year yields going higher?
I probably see them leaking a little bit higher. In general, I do think we're going to see lower yields over the course of the year, but we moved too far too fast. And what I was a bit surprised by, but I kind of understand now, is we've moved to the zone and everyone's seeing inflation creep back up. So we're going to respond to that. I think it's going to turn out to be incorrect, that we're still on the trend to lower inflation and potentially deflation, but that's not going to stop the market from trying to price in a bit of inflation. And I think the Fed's going to have to talk very, very hawkish after the jobs report on Friday.
So in other words, you think that we're going to hear from Fed Chair Jay Powell some real definitive statements on the risk of inflation and talking down, frankly, some of the easing that we've seen in financial conditions?
I do. I think he tried to say some of that Wednesday, and he mentioned disinflation too often. He was maybe a little bit too generous on the balance and the data dependency. Well, they got this first piece of data. I think it spooked fear. You've already seen a couple Fed speakers come out, I believe Bostic and Kashkari, really saying that they have to hike more. I think he's going to follow that mode, and he's going to try and take away a lot of the gains we saw last week.
Peter, the heritage of Academy Securities, I'm going to suggest, is they speak to an older cohort that has a collective memory of other times. Part of the angst right now is a younger cohort that feels if we raise rates, OMG, we're all going to die. Push against that. If we raise, or if we sustain rates here, Lisa mentions a near, what is it, Lisa, 5% T-bill? Something like that?
4.8%.
You know, if we're, OMG, rates are so high, we're all going to die. Push against that angst.
So I still think rates are only a part of the equation. I think right now we're going through what we've been calling 5 steps forward for tech and 2 steps back. We had this huge phenomenal growth, some of it, pre-COVID, but COVID certainly introduced a lot. And then you had the valuations for all these disruptive companies. Everyone was chasing tech. Everyone needed as much tech as possible. Now everyone's saying, what do I own? What tech do I already have? Let's be a little bit cautious on expenses. So I think we're going through that. So I think the Fed should just stop, let these things settle out, and we should already be starting to talk about how do we build our supply chains? How do we build foundries in the U.S.? How do we bring back medical equipment? All those things are what's going to be important. That's what's going to drive the economy for the next 3 to 5 years. And guess what? We will probably have 3 to 4% inflation if we do that, but that's good. Right? People, I do think, remember the good days where you had inflation, jobs are plentiful, and people could make money and have good lives.
I mean, the president's going to stand up tonight with a victory lap like we've never seen. Peter, you're too young to remember this, but The Fifth Dimension had the #1 song in the country, Age of Aquarius, the last time the unemployment rate was here. I'm not going to sing it right now. I've been banned by Mike called from Bermuda, I think, and said,
You do that one more time.
Thanks for, one more time and you're done. Peter, the equity market here, do corporations adapt to all this gyrations of Fed policy?
Yes, but I think they have been adapting, and I think that's what the market got ahead of itself is things take months in corporate America to take place, right? People are putting in decisions that were made in December only now. So I think the spending slowdown is continuing. I think these hiring freezes, cutbacks are continuing. And again, I think it's going to be very unique where it's going to be this mid to high level person who maybe got overpaid during the post-COVID breakout at these disruptive companies. They're most at risk. This isn't going to be a recession that hits low-income earners that much. It's going to be that swath of people, and that takes time to play out.
Middle managers, and we're seeing that pretty much across the board, that the middle management quadrant is really the one that has been hit the hardest by some of the layoffs announced. Peter, you said 3 to 4% inflation looks likely over a longer term if the U.S. does invest in some of these supply chain issues. What does that mean for credit, given where yields have been for so long? What does that mean for the NASDAQ and tech valuations?
I think ultimately it'll be very good. I think we're going to have to digest to this higher cost, but then people will realize that there is some safety in this. And probably the most interesting discussion we're having right now is people are really thinking at the corporate level, what is the cost of a widget? If it costs 80 cents here but $1 here, is it really pari passu? Is it the same? And I think people are taking into account supply chain security, job security, all these things much more than they have in the past. And that's one reason I think the government's going to have to kick in. And some of the stuff in the Inflation Reduction Act, the CHIP Act is helping that, right? We're going to have to nudge this along, but that's where the job growth is going to come. And that's why it's going to be okay for these companies longer term.
Well, there's something really important here. Peter, you're saying that basically this is good for companies, even though, even their returns, even though a lot of people have been talking about higher inflation means higher yields for longer, and that's going to really challenge some of the valuations that we've seen over the past few years. So are you seeing strong returns from both equity and credit over the next 5 years, despite higher rates?
Yes, I think we have a bit of a shakeout coming right now. We're still having to adjust to this. I think we're going to have a bit of a deflationary scare, but assuming we do the right things and we start rebuilding our supply chains, we work with countries that are easier to work with, we will see great economic growth. I think we'll see a much more stable middle class. I think some of this political divisiveness we see will start to dissipate as well.
One person who just was watching said, where you think real rates need to be longer term in a situation where you have 3 to 4% inflation?
Probably in that 3 to 4% range. I think we don't have to have significant real returns. We do need some real returns. I think negative real returns is a disaster. So I think we need to keep it at positive real returns. And we're probably at rates where the Fed could leave it alone and we would manage that, maybe even cut over time.
Peter Scheer, thank you so much. Greatly, greatly appreciate it this morning with Academy Securities. Just a nice summation there as we go to the chairman's comments with David Rubenstein at 12 noon. We have not spoken of Turkey today, and it's something that all of us are, I'm just absolutely stunned with any experience I've seen with earthquakes. I just don't think there's anything that equates in my lifetime to this, Lisa. And the USGS, of course, with their world class, they adjust this number. It's not cast in iron. 59 aftershocks off of the original 7.8 earthquake. As we went to air this morning, there was a 5.4 aftershock and in the last hour or so, 4.4, which is smaller, but nevertheless, with those broken buildings, those broken people, these small earthquakes aren't to be underplayed, these aftershocks.
It's heartbreaking. And some of the stories there, especially of the area on the border between Turkey and Syria that got hardest hit. This one town that was the epicenter, Gaziantep, was home to 2 million people, basically homeless, uprooted from their homes due to the civil war. How do you dig your way out of this on a real and a figurative sense after such incredible destruction?
And the bravery, some of the images we've seen of buildings falling in real time, and the bravery of the people trying to make an effort here in the cold has really been something. It'll be interesting to see how the president addresses this evening.
And
He's
just
got to mention it.
And just in general, how the world kind of helps support some of the rebuilding, especially given the balance of focus right now in other regions.
I don't know which to go to, Chairman Powell's comments, or I guess in respect, I'll go to the president. What will you listen for in tonight's State of the Union?
In the State of the Union, I think that international actually is going to be really interesting with China messaging, especially with what Henrietta Trace was talking about in terms of the potential headline risk for certain corporations that lean on China, but also just in terms of how he sets up his campaign, whether he opens the door to anyone else in the Democratic Party, whether he does hew to the center. What are you looking for?
I'm going to we'll see if he speaks to the senator from Massachusetts, Elizabeth Warren, where she says, would everybody stop this elite navel gazing? We are employing America. And to me, that's the key thing to see how he addresses this stunning unemployment rate. David Weston leading our coverage tonight. This is Bloomberg.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
2 days of losses on the S&P. Will we make it 3? From New York City this morning, good morning, good morning. Equity futures down about 0.1%. We're all waiting for Chairman Powell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Chair Powell taking center stage in Washington just before President Biden addresses the nation as this year's epic market rally flies into some turbulence. We begin with the big issue. It's Chair Powell, Volume 2.
You're going to hear Powell at the Economic Club. Fed Chair Powell, you've had a subtle change since the Fed meeting.
The kind of strong payrolls report you got, but also the non-manufacturing ISM.
He basically said, all right, you guys want to play data dependent, we'll play data dependent. And guess what? The data was really hot.
I don't think he's necessarily going to take back some of his comments.
He doesn't have to walk much back. I don't think that the data we saw Friday really changes much for the Fed when they look at the March meeting.
You have a different message right now.
Interest rates have definitely changed. They have gone up.
Real interest rates based on forward-looking break-evens are about 2% or higher.
They're going up because growth is proving to be stronger than expected.
Now he can let the data guide them.
That's a different flavor of rate increase. It's
Joining us now to discuss is PGIM's Lindsay Rosner and Colin Martin at Charles Schwab. Lindsay, first to you. After that monster payrolls report on Friday, what does it change for this chairman?
Yeah, I think what it shows us is that the economy is really hot. And that was what I think we were told by Powell. I'm not sure markets wanted to listen. So I think Powell's message was loud and clear. Not free to move about the cabin right now. Buckle up. And that number definitely was a bit of turbulence. So going forward, I think the Fed and Powell very much feel emboldened to get to their dots and stay there and not cut.
Citi on board as well. Andrew Hollenhorst had this to say this morning, 517,000 new jobs. He's calling it a clear sign of an overheated economy. Powell should sound more hawkish today. Colin Martin, do you agree?
Well, I don't think one jobs report's necessarily going to change the tone, but I do think Powell can be a little bit more hawkish in today's comments. What we heard last week was a little bit different than what we think the markets heard, because when you look at the statement made it very clear that multiple rate increases were likely. And Powell kept talking about disinflation, and it seems like the market picked up on just the term disinflation itself, but what we heard was that process had just started. So I think we're going to hear about where he views that process, but also financial conditions. That's still the mystery out there, especially his comments about financial conditions not really moving much recently, when what we're seeing from the indices we track is that they're still accommodative and they've eased significantly since last December. So I think that'll be a key question and something that the markets are going to be focusing on.
Well, this market has adjusted post-payrolls to a higher terminal rate in line with the Federal Reserve. Lindsay, where the spread still exists and persists is between the Federal Reserve and the market over rate cuts. Do you see that as confusion over the Fed's reaction function, or just a disagreement, a different view on how this economy is going to develop in the next coming months and quarters?
Yeah, so I think it's a slightly different view, but the really big thing is there has been a huge change. Basically, all the cuts that were in the back half of 2023 have been taken away. The market is not expecting that anymore, and you have to squint now to see the difference between what the Fed thinks will happen and what the market is saying. And I think that that's actually a really good thing for markets writ large, because you're not going to have that volatility of the chasm that existed between those two entities prior to this past week.
Getting a ton of Fed speak this week, not just Chairman Powell. We heard from Raphael Bostic of the Atlanta Fed in the last 24 hours here at Bloomberg. He had this to say: I've said for a long time that I thought there's a lot of momentum in the economy and that there was a good chance that the momentum was going to be sufficient to absorb our policy tightening in ways that could help us avoid a recession. He's in camp soft landing. He's looking for higher interest rates potentially as well. Mike McKee's got to break this down for us. Mike McKee, the latest from Chairman Powell, does it change after that payrolls report?
It doesn't change. It's a question of whether the market changes. I mean, our story so far, you just kind of went through it, was last Wednesday, Powell talked about the fact that the Fed is going to raise interest rates and keep interest rates at a high level, but there is some disinflation out there. The market's only heard the disinflation part. And then Friday, we get the extraordinarily strong jobs report, and markets begin to think Powell meant it. So the question today is not what Powell's going to say, but what's going to be the takeaway in the markets? Does he strengthen his message? Do the markets really buy into this? As of this morning, they do. You look at where the markets are pricing the terminal rate for the Fed, and you can see what happened here where we have Wednesday outlined and then Friday outlined. Since then, markets have really moved up. They're above 5.1% this morning, which is what the Fed's dot plot consensus had said would be the terminal rate. So markets are looking for Powell to be more hawkish today. I'll finish up with what Raphael Bostic said, because it is important if this is the way the Fed is leaning, and that is that the economy would now expect them to translate into raising interest rates more than they had projected. If everybody starts moving up their forecasts, we'll get new ones at the March meeting, then there's going to be a lot of adjusting to be done on Wall Street.
Looking forward to those forecasts a little bit later. Mike McKee down in Washington. Mike, thank you. Colin Martin, let's build on that. The prospect of a higher terminal rate. Reason to believe that might be the direction of travel.
It's certainly possible based on all the economic data we're seeing right now. I mean, the market is pretty favorable right now. If you look at the labor market, if we take away all the headlines that we see in the tech sector, and I think we need to step back and really evaluate what that's telling us, they don't make up a large portion of the overall workforce. They make a lot of headlines. They come from a lot of the high-flying stock entities. But at the end of the day, they're not the ones that really drive the labor market. And if we look at the JOLTS numbers, which surprised to the upside, the labor market, obviously, with the non-farm payroll surprising to the upsides, and then initial jobless claims continuing to decline, that shows us that the labor market is still strong and that the economy can potentially keep chugging along. Those are all good things. And what that means for the Fed and what that ultimate peak rate is, that they might be able to keep hiking rates. If the Fed can get to inflation around 2% and the unemployment rate only rises a little bit, I mean, the way I view that is that could be somewhat neutral at the time. Obviously, there's a lot of questions about what the neutral rate is over the long term, but if that balances the economy, that's ultimately a good thing, and why we're not expecting rate cuts anytime soon. So the Fed's only going to cut rates if they need to.
Let's talk about what it means for the market then, Colin, off the back of that good news. Is it good news for financial markets? The S&P 500 year-to-date is up about 7%. I think the Nasdaq's still up about 13.9% year-to-date, even with the 2 days of losses. You know the story with the US dollar. I think it's down about 10% from the peak at the back end of September. Credit, you were looking for wider spreads, Colin. Credit spreads since the wides of last year are 200 basis points tighter. And if you go to the junkest of junk, triple Cs, they've been running in too. Can you make sense of that for us? Isn't that just in line with a better economy?
It really is, and you're right. We were expecting wider spreads this year, and I think over the long run we still expect that to happen. But I think we want to break it out into what environment is this? Is it a recessionary environment or a non-recessionary environment? And credit spreads are telling us that it really isn't. That if that timeline gets pushed back, then spreads maybe at the 4% area for the high yield market is appropriate. We still think over time that we'll see those spreads rise, and how we're approaching the market, we still favor IG right now. If you can get average yields around 5%, we'd rather do that without taking much risk. Because if you look at high yield bonds over the long run, say 2 years, 3 years, an 8%-ish yield looks pretty attractive. But because spreads have come down so much, that break-even spread, how much spreads need to rise or could rise before that excess return is wiped out relative to treasuries, that keeps coming down. And all it would really take would be, a small little bout of volatility to see spreads rise back up to that 5% or so area. So we're still a bit cautious right now, but the markets, based on what we're seeing with new issuance, what we're seeing with the triple C market, as you just alluded to, is telling us that credit markets aren't too concerned right now.
I mentioned the low quality bias. Triple C spreads have tightened about 300 basis points from the wides of October. Lindsay, can you make sense of that for all of us?
Yeah, I think it's just the pricing in of a soft landing. We've gotten a lot better economic data that is decreasing the amount of recession risk. When I spoke to you last, Jonathan, we happened to talk about our base case being a garden variety recession. And given the new data, we've had to say, you know what, soft landing is edging out a little bit more. And you're seeing that come through in just those big high yield spread numbers you're discussing. But I think what's really interesting about the high yield market and what we're excited about is that there's dispersion. And dispersion is a great place to be if you're an active manager doing that security selection. And the dispersion in the high yield market actually is getting pretty close to the levels it was in 2019. That is a great opportunity. And that dispersion, I think, is a bit of a canary in the coal mine to tell you that there will be winners and there will be losers. And that's the kind of environment that we envision having for the rest of the year. It's been great that there's been a rally, but you have to be careful.
Can you just build on that a little bit, Lindsay? Where is that dispersion within industry groups? Where do you see that most pronounced within certain sectors?
Yeah, so when we're looking at dispersion, we're looking at name specific and where spreads are even within intra-sector. So it really is across the board that we can find opportunity. I think, to your point, triple Cs have done really well this year. They've tightened, and you kind of see this bigger theme of a compression trade. But we'd be wary of that, and that it's really picking out those values that we find and relying on our credit analysts to do so.
Some people, Lindsay, might say this is far too complicated for me. I can get 445 on a 2-year. Why wouldn't I do that?
Yeah, I think the big thing, and we've had a lot of conversations with clients who are discussing just that. I mean, certainly you have a yield in the front end of the curve that you didn't have a year ago, 2 years ago. We had been in that zero or even negative rate world. Well, the problem is reinvestment risk. So it's great that you can collect that for 2 years, but in 2 years' time, what are you actually going to do? And the other part of it that I think Colin was touching on is real rates. What are you actually earning from a real rate perspective? And so maybe it's a good portion of your portfolio. We don't believe it should be the whole thing.
Colin, final word.
Well, I'll touch on the point you made before about the pushback from a lot of investors about the short end versus the long end. It's the number one question we get, and admittedly, it's something that Tom Keene brings up with me and Kathy Jones all the time when we're on here. Why would we even consider intermediate or long-term bonds? And I'll just, follow up on Lindsay's point about that reinvestment risk. Yes, you're accepting a lower yield with a 5-year, a 10-year, you name it. But at some point, as the Fed rate hikes take hold and that slows down the economy and brings down inflation, that at some point will bring rate cuts. And once that happens, for those waiting to invest, waiting for that peak Fed funds rate, they might have already missed the peak in intermediate or long-term bond yields. So we'd rather not wait, just lock those yields in with certainty, but overall, as part of an overall diversified portfolio to take away the timing aspect.
Colin, did I ask a Tom Keene question? In which case, I apologize, I'm sorry. Colin Martin, Lindsay Rosner, sticking with us. Coming up on the program, President Biden preparing to address the nation.
We have a strong and resilient economy. I know President Biden will talk about that.
That conversation up next.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City,
From London and Sydney.
from Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
We have a strong and resilient economy.
The striking labor market report that we got on Friday obviously punctuated a historically strong period in the labor market recovery.
Last month, we created over 500,000 jobs, more than 12 million since the president took office.
We're seeing inflation moderate.
What I see is a path in which inflation is declining significantly and the economy is remaining strong.
Fresh tensions with China and a showdown on Capitol Hill looming over President Biden's State of the Union address. Speaker McCarthy calling the president to the negotiating table ahead of his big night.
Mr. President, it's time to get to work. The problem only gets solved when both parties come to the table. No drawing lines in the sand, no policy gimmicks or political games. We can have reckless spending or we can have responsibility.
This coming as the president looks to renew his proposal for a billionaire tax. The White House preview of the speech reading, quote, "This minimum tax would make sure that the wealthiest Americans no longer pay a tax rate lower than teachers and firefighters." For more down in Washington, here's Bloomberg's Anne-Marie. Anne-Marie, let's start with what's possible in this address later.
Well, not much when it comes to a billionaire's tax, Jonathan, or as well as quadrupling the excise tax on share buybacks. Remember, in the IRA, they were able to get a 1%, but many Democrats say that is just not high enough on these corporations. The issue is the president is facing a divided Congress. So a lot of this legislation he may want to pitch just has no legs in Congress right now. But the economy will be front and center. That is what Brian Deese told us yesterday in this speech. The president was given a gift on Friday. As he walks into this speech, he can claim that under him being president, it is the lowest unemployment rate since 1969. He was 26, 27 years old, John, when we saw an unemployment rate this low. He is now 80 years old. The issue the president has is his polling numbers. The American people don't feel the economy that he is talking about, and that is a difficult position for him as he faces, one, a divided Congress, and also as he plans to announce a 2024 bid.
Just on the debt ceiling debate, there's a passage in this fact sheet the White House put out yesterday. It reads as follows. President Biden's predecessor passed the nearly $2 trillion unpaid-for tax cut with benefits skewed to the wealthy and large corporations. And the deficit, and I think this is the key line, Anne-Marie, the deficit went up every single year under his watch. Do you expect that to be mentioned a few times later?
Absolutely. The debt ceiling is going to be looming large, and also they want to make sure that they are precisely pointing out the timeline of the debt ceiling. Republicans would like to say this has to do with Democratic spending. They don't want to talk about these tax cuts under the Trump administration, which we should know, Jonathan, many of those tax cuts still remain in place, even though last year there was a Democratic House, a Democratic Senate, and obviously a president from the Democratic Party. One key issue, though, is Speaker McCarthy yesterday, and you played some of that sound. He was speaking on the Capitol. He said there should be no lines drawn. But an hour later, a reporter asked him, when you want to decrease the deficit, would you consider tax hikes? He said, no, we will not. So in a sense, a line was already drawn by the Republicans. So this is going to be a showdown early this summer.
There is a spot where Republicans and Democrats might agree. China might be one issue. Here's another.
Yes.
And it might be connected to that China issue as well, that the Europeans have got a voice on this too. The administration is issuing proposed guidance to, quote, ensure construction materials from copper and aluminum to fiber optic cable, lumber and drywall are made in America. Anne-Marie, can something be done there? And what will the Europeans say about it?
So two things on this. One, it'll be hard to hear Republicans say they don't agree with that. Already the administration is trying to do this with the Inflation Reduction Act. If you want to get some of those subsidies and tax credits, they want these products built in America, but also critically the raw materials coming from America. This is where the Europeans think they can potentially make a play into getting involved in the IRA. And I spoke to Robert Habeck yesterday, the Vice Chancellor of Germany. He's the economy minister. And this would be a club, Jonathan, of sorts, a raw materials club. What's interesting, though, is that if you try to do this, it could potentially be a big hurdle for companies. Raw materials like aluminum, like copper, we saw this in the oil market, these are priced on a global commodity market, right? And some of the cheapest products are coming from China or coming from Russia. but potentially the president is going to be leaning into this a little bit more this week or last week. We talked about this yesterday. They're looking at a 200% tariff on aluminum for Russia, which basically means that any Russian aluminum will not be making its way to the U.S.
MH, thank you. And just for our audience in the UK, I know aluminium, but I'm just reading it verbatim off the fact sheet from the White House. Anyway, MH, thank you. Lindsay Rosner, Colin Martin, back with us. Colin, this nearshoring theme, deglobalization, all of the above, is that a theme for you as you look across this market?
Well, it's always a thing. One thing we look at, especially to the points you were just talking about, anything about uncertainty or the possibility of raising costs, that just plays into, one, the inflation theme, but also some sort of risk premium. If there's concerns about where we're going to source things, what the prices are, then we'd expect, maybe some volatility and some risks premiums to rise. So we're certainly looking at those. I think there's enough going on in the U.S. in terms of all the things we just discussed with the labor market, disinflation, Fed policy, but of course, things like that do play into our outlook, but they're probably taking a back seat right now.
Well, as you know, Colin, about 95%, 99% of these things is about conveying values, not about establishing a path forward to change policy anytime soon. But Lindsay, on the debt ceiling debate, it's not going away. As much as we hate it, and as much as a lot of people are exhausted by it, it's going to have to be something we talk about. Lindsay, what are you telling clients?
Yeah, we are absolutely going to have to talk about it. My hope is we don't have to talk about it until the dead date of August, that we can close out this conversation earlier rather than later. But it's absolutely something on the mind of clients, and it's important. We've been on the door of this before, and it obviously roils markets. I think you already see it in where U.S. CDS is trading. First of all, the fact that it is trading again, it wasn't trading for weeks, and now is actually a moving contract, that is moving higher. And so the risk is being entered into the system.
Is it doing anything to erode appetite from international investors looking at the fixed income market in America? Is it doing anything at all?
No, we have not seen that yet. We've definitely seen overseas interests overnight, especially in the investment grade market. This kind of goes back to what we talked about last time I was on the show, which is just this is a great year for bonds, yields, spread. And as my colleague Mike Collins said on Friday, with all the hikes that have been put in and where we eventually get, let's say that's 500 basis points, in some ways there is the potential for a Fed put maybe again. They have the ability to cut to help the economy. Those things I think right now are far more important and far more critical for overseas investors when they're thinking about our market.
Lindsay, you've just got to build on that. Are you saying that after a year of talking about a Fed call hanging over this market, the Fed puts back?
I think it can be brought into conversation. It's certainly, we're at a different point, right? We've got 450, 475 basis points of room now if they needed to cut. That is a totally different story than where we were a year ago. So that cushion, and I'm not saying exactly where that Fed put strike is, don't hold me to that, but that it should at least be something that we do discuss because we're in a much different situation and a better one, I would add.
I was getting ready to clip it to play it back to you next time you come on. Colin, final word on that.
Thank you.
Final word is the dangerous words from Lindsay to say Fed put on a Bloomberg The Open. I think she makes a good point about how much room they will have to cut, though. So we'll stop short of saying there's a Fed put. I think what we're going to see this time around, where if the recession, if it ever does come, if it's more shallow and not what we saw over the past two, maybe we don't get back down to zero, right? Maybe they get down to the 2%, 3%, something like that. But they do have plenty of room, significantly much more room to cut if they need to for now. So I think that is a good thing in the grand scheme of things.
It's amazing. Unemployment's at 3.4%. We've just had a payrolls report, 517,000 jobs, and we're still talking about the prospect of rate cuts. Colin Martin, Lindsay Rosner, to the two of you, brilliant as always. Equity futures right now down 0.25%. No real drama here. Up next, the morning calls, and later, why the latest read on inflation could unravel this year's rally. Citi Stuart Kaiser around the opening bell.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make
Equities a little bit softer. Let's get you some morning calls. First up, Credit Suisse upgrading Lockheed Martin to outperform from underperform, raising the stock by 2 notches on the company's improving growth outlook. Goldman downgrading Tyson Foods to neutral, saying cyclical headwinds should continue weighing on the company's profitability. And finally, Wedbush cutting its price target on Bed Bath & Beyond to 0, seeing a low probability that the retailer avoids filing for Chapter 11. That stock down 45%. Coming up more on Bed Bath & Beyond's latest efforts to elude bankruptcy, plus short-dated options adding fresh fuel to the meme stock trading frenzy. That all coming up next with Stuart Kaiser of Citi.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
2 days of losses on the S&P 500. Can we make it 3? Equity futures right now down about 1/4% on the S&P. On the Nasdaq, down about 1/10%. Last couple of days, over the last 2 days, we're down by about 1.6% on the S&P. On the Nasdaq, down by about 2.6%. Still up on the year, big time. There's your opening bounce. Switch to the board and get to the bond market. Yields look a little something like this, turning higher by a basis point, about 3 hours away from hearing from Chairman Powell. Your 10-year, 365. Your 2-year, nicely through 440 in the last 24 hours. Right now, 445. It means some more dollar strength and euro weakness. Euro dollar last week, high of the week, high of the year, 110.33. Now back down to 106.92. We're down 1/3% on that currency pair. Looking at crude, we're positive 1 full percentage point, just short of 75 at $74.90. About 30 seconds into the session, no real drama here. Down 0.2% on the S&P, and the Nasdaq virtually unchanged. One stock to watch at the open, Royal Caribbean, reporting a smaller than expected loss with pent-up demand helping to offset rising fuel prices and a strengthening dollar. The CEO said this: travel strength continues as consumers shift their spending towards experiences, with cruising remaining an attractive value proposition. Apparently, Abby. Hey, Abby.
I'm with you on this, John. I was not a cruiser ahead of the pandemic, and I'm certainly not now. But apparently a lot of people out there are, and there's new cruisers too, because bookings, that's the key to this story. Very, very strong, taking the stock higher. Its best day in almost a month, and then also suggesting that they are going to have record EBITDA for 2023. So there's lots of optimism about 2023. That quarter that just was, it was a little messy. Yes, they did put in a narrower loss than expected, but it was still a big loss. Sales were a little bit of a miss. But looking ahead, they are again looking at that record-breaking wave season that you were talking about for the quote-unquote cruisers. Translation, that means that the bookings between January and March are very strong. And it comes off of a quarter that, even though the quarter was a little messy, more bookings than 2019. Imagine that. What's interesting here, though, John, the stock is still 48% below its pandemic high. For 2023, we are again looking at record EBITDA. We're looking at sales that were higher than 2019. So I'm betting that there are a lot of investors out there in Royal Caribbean that are hoping the stock follows those bookings, EBITDA, and revenue.
It's not a comment on the stock. I just don't ever want to go on a cruise. I always see the commercials for cruises, and they always say at the end you can make new friends. And I'm like, I don't want to make new friends, and I certainly don't want to meet strangers in the bar every single night. I mean, that just does not appeal to me. You want to go on vacation and get away from people, not bump into the same people and get trapped on a boat. That's over. Abby, thank you. Another stock to watch, Pinterest. The company reporting sales that missed estimates amid an advertising slump. The CEO said this: we're very much focused on making sure that we return to user growth, but we are more concerned about driving deeper engagement. Kelly Lyons wants to talk about that, and I know she's got a rant of her own on cruises.
I just really want to tell you, you can't knock it till you try it, John. I am totally a cruise person. It's not about having to interact with people. It's about getting on the boat, and you don't have to do anything else. It'll take you to all those different places. Anyway, Pinterest, which admittedly I also was a user of, especially when I was planning a wedding, isn't doing so well when it comes to the top line numbers. The stock's down about 0.8% as a result. This really is an advertising story, John, because this is obviously a social platform that gets its revenue via advertisements. And we know that there is an advertising slowdown, which is why they just saw their lowest pace of revenue growth on record, 3.9%, really coming down from the highs we saw prior to the pandemic and then over the course of it when everything online was doing so well. But now it is a very different story. And to put it in the words of one analyst over at Baird this morning, this is a second-tier player. So if advertisers are pulling back, the dollars that they do spend are likely going to go to the bigger players like Alphabet or Google and Facebook. Those have about 70% market share compared to just 0.6% for Pinterest. So that paints a pretty tough picture for them there. If there is one bright side, though, that the sell side is pointing out today, it's that engagement and user trends seem to be improving. Engagement like pins and comments is up about 10%, and they did just fractionally beat on monthly average users as well. So maybe that is why we are seeing not too deep losses in the stock this morning, though now they do seem to be deepening a bit, down about 2% before the bell. Also, go cruises, John.
Kaylee, I'll let you have the final word. Kelly Lyons, thank you. Also keeping an eye on Bed Bath & Beyond, shedding nearly half its market cap after announcing plans to raise $1 billion through an equity offering. Wedbush cutting the stock's price target to 0, running in a no. We see these capital raising transactions as a last gasp to survive before filing for bankruptcy protection, where the common equity would likely be worthless. Bloomberg's John Edwards joins us now. John, fantastic to catch up with you. Run us through the state of play here and the chances of avoiding bankruptcy.
Yeah, it's an open question still. I mean, Bed Bath & Beyond, by its own admission, has been at the brink of bankruptcy for weeks now, and it did, late yesterday come up with this last-minute reprieve, offering some preferred shares and warrants to raise about $1 billion. So that should help it stave off a Chapter 11 filing in the immediate term. However, as you see, analysts are skeptical that this is going to be a long-term rescue for the company. It still has to fix its severe operational problems. It's having trouble keeping its shelves stocked. It's having trouble appealing to shoppers because they see that they're not able to find what they are looking for. So that remains an open question. And we'll have to see if this is really the rescue that they think it is.
Well, John, when you say the immediate term, I know this is so tough, so difficult to answer, but how much time have they bought?
Some analysts are saying, maybe a couple of quarters, maybe a little bit more, but it's again, they've really got to get that operational situation turned around quickly. I mean, they've had double-digit declines in same-store sales for several quarters now, and it's just it's not a healthy situation for them.
That stock has been all over the place. John Edwards, John, thank you. The stock is down by about 39% in early trading. 6 minutes into the session, the broader equity market on the S&P down 0.25% on the Nasdaq, down 1/10. Citi Stuart Kaiser looking for next week's inflation report to give markets a dose of reality. He has this to say: markets continue to sidestep 23 landmines, with events failing to produce negative enough outcomes and pressuring conservative positioning. We see risk tilted to the downside, with the onus now on CPI to disrupt the apple cart. Stuart, I'm pleased to say, joins us right now. Now, Stuart, before we get into it, there was a great piece in Barron's over the weekend about really short-dated call options. I want to share a quote with you and get your thoughts on it. It said, speculation has returned in another acronym, 0DTE, which stands for 0 days to expiration options. To help traders scratch that speculative itch, the exchanges have been offering ever shorter options until they got to 0 days to expiration. Now, Stuart, can you tell me about the kind of volume that we've seen in those very short-dated call options and what it may be doing to the broader market?
Yeah, Jonathan, it is kind of a new theme. I think it's a little bit distinct from the sort of retail options flows that we saw a couple years ago. But basically, in the S&P 500, you're trading about 45% of your total options volumes in options that expire by the end of the day. So call it about half of the options that are being traded expire, at the close of business on the day. So it's a huge thing. I would say the impact on the market is a little bit harder to discern. It's a lot of volume, it's a lot of churn going through the market, but contrary to other sort of fads we've seen in the last couple of years, which was very much people buying call options to have upside risk, this trading of zero-date options is actually much more balanced between puts and calls, and I think for that reason you're kind of seeing it impact the market a little bit less on an intraday basis. Some people have speculated it's one of the things that's driven high intraday volatility because it's allowing people to add leverage to their kind of intraday risk-taking. And I think that's a possibility and still an open question. But regardless, it's a massive theme in options markets these days.
Well, what I'm trying to figure out is how much of the price action is just a technical story that we're trying to assign a narrative to, a fundamental narrative, Stuart. Just the year-to-date epic rally we've seen in some of these big names.
Yeah, look, I think the zero-date options, though, generally is not a single stock phenomenon. Most single stocks do not have daily options listings the same way the S&P 500 does. So while you may have people trading short-dated calls, let's say, on a Meta or a Google or pick your large-cap tech company, those are generally not going to be zero-day options because you just don't have 0 days listed for most single stocks. So this is, kind of more of an index phenomenon than it is a single stock story.
Stuart, any difference this year to what you might have seen in years gone by? I remember discussing this in September 2020 and that mount up we saw in the Nasdaq. Any difference to what we're seeing now compared to back then?
Yeah, definitely. I would separate those into two slightly different categories. Back in 2020, this was largely retail investors buying call options in kind of 1 month in expiries on essentially large cap tech or popular names, right? And because that was flow that was one way into the call wing, it actually did impact the way that options were being priced. In our parlance, it inverted skew, i.e. your call was more expensive than your put, which is highly unusual. What we're seeing today, though, is not really single stock. It's much more S&P 500. And it's zero date options, more balanced between puts and calls. So again, I think they're similar in that they're new developments. It's a lot of options volume being traded in the front of the term structure. But I would kind of separate out the retail flows going into tech call options from what we're seeing in zero date options on the S&P 500.
So that's the difference between now and 2020. I want to talk about 2022 just briefly. You put out a note in November, and I remember this note, and I went back into it last night just to read through it. And you said this: will inflation crest before growth deteriorates, and let the FOMC deal with those risks to its mandate separately? For markets, how long an investable window is there between these two waves of economic risks? Now, Stu, I'm sure you remember writing that. Now, can you tell me where you stand on that now? How big is that window?
I vaguely remember it. Look, I think, obviously the window has proved to be longer than most people expected, right? I think a lot of people positioned that early in 2023, we were going to be more aggressively trading recession risks and growth risks. And clearly the data to this point has not provided that level of clarity on the downside, and the market's rallied. So from my perspective, I think the window is longer than we expected, and frankly, it's much longer than I think the bear case expected. I really do think people came into this year generally very conservatively positioned in the stocks they owned, and owning less stocks than they historically have, in anticipation of kind of hard landing risks on the U.S. economy. And that hasn't played out. And really what it's allowed is allowed the market to rise. It's allowed the Fed to continue to message very hawkishly, because they're not bumping into a severe deterioration in economic data, and particularly the labor markets.
With that all in mind then, Stu, how appealing is it to take on downside protection going into something like CPI next week, or to the risk events on the horizon in the not too distant future?
Yeah, it's a great question. I mean, from my perspective, being here above 4,100 is a very uncomfortable price level to be in, given the views on both economic growth and inflation. So I do think that CPI print is kind of a sneaky risk event, just because investors have largely assumed away inflation risk. So if you were to get a little bit of a surprising print there after what was a very, very strong labor market report, it's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen, because a lot of macro and hedge fund investors in particular are very uncomfortable with the market at these levels. So if you have an excuse to sell it, from CPI, I think they'll take that opportunity. It is not as big a risk as it has been in recent months. I would say from a volatility perspective, it's priced at about 75%. The size of the event's about 75% of what it was last month. So big, but maybe not on par with recent history.
The ultimate risk event last year, as you know, was just pricing the Fed. And if you couldn't price the Fed, you certainly can't price the risk-free asset, treasuries, and you certainly can't price risk. That was because we went from a Fed calling for, say, 90 basis points of hikes last year to pushing through more than 400. There was just a feeling that we'd come into 2023, Stu, a little bit more comfortable, that we would understand that story more, that this Fed would ultimately get to say 5 and then stop, and then we'd have this conversation about cutting. After that payrolls report on Friday, do you think it reintroduces the risk we have this conversation about a Fed going to even higher levels than we thought about maybe in the last 12 months?
Yeah, look, I agree with you 100%. I mean, I think one of the big headwinds to risk-taking last year was bond volatility, which obviously came from volatile inflation data and an uncertain Fed, policy path. So this year, as we've transitioned, I think there is less bond volatility, obviously, in the markets, and I think there is less uncertainty about the path of the Fed, right? Even if you think, as our economists do, you're going to get multiple more 25 basis point hikes, that's not the same as going from 25 to 50 to 75, to talking about potentially 100, right? So the volatility coming from the Fed and from bond markets this year is, I think, undeniably lower than last year. Could it tick up a bit from how it's been early this year? 100%. That labor market report clearly made people uncomfortable. But I think there are some people also looking at that labor data and saying there was something a little odd here in some of these seasonal adjustments. And, if that number had been 300 instead of 500, the markets probably would have reacted a bit differently. So, big picture, yes, there is still some uncertainty from the Fed, but I believe bond volatility and Fed uncertainty is significantly lower than last year, which has certainly helped risk premium. Frankly, I think it is correlation between bonds and equities right now that's the bigger issue.
Final question, Stu, and this is an important one. Katie wants to know. Do you like cruises?
Well, you know me, John. I get on a cruise, I read about the Dow, and I just relax, So that's how I
get off the show.
No, I've actually
You're
never
killing
been.
me.
I've never been on a cruise. Never
going to go on a cruise. And never look at the Dow. Stuart Kaiser there. City. Stu, thank you. The Dow and cruises. What's worse than that? Coming up, tensions flaring between the US and China.
We made it clear to China what we're going to do. They understand our position. We're not going to back off.
And that conversation still ahead.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We made it clear to China what we're going to do. They understand our position. We're not going to back off. We did the right thing. And there's not a question of weakening or strengthening. It's just reality.
US-China tensions looming over Washington as President Biden prepares to deliver his State of the Union address.
All senators and both parties will be briefed by the Department of Defense. The briefing involves where we stand with respect to China on everything from surveillance capabilities to research and development to advanced weapon systems and other critical platforms.
Emily Wilkins down in Washington joins us for more. Morning, Emily.
Good morning, John. Well, obviously this balloon has raised a lot of concerns in Congress on a bipartisan basis. You've heard that Republicans are interested in looking into some sort of resolution condemning China's government for the balloons and looking into as well as what the nature of these balloons are. We're now hearing reporting that there were a number of them during the Trump administration. That, of course, raises questions about what they're going to look like. And it will be interesting to see if Congress can actually muster a bipartisan support here. Initially, Republicans wanted some sort of resolution condemning the Biden administration for how they handled it. But there are also thoughts within both parties, really, that the focus here should be on Beijing and on China. Certainly we'll be keeping an ear open tonight to hear whether President Biden is going to be mentioning Beijing in any of his remarks. It is one of the few issues right now where Congress is unified. You see a lot of Republicans and Democrats be on the same page when it comes to China. And while we're expecting an all-hands-on-deck briefing for the Senate on Thursday, the House has requested similar. Also expect this to come up in hearings throughout the year. I spoke last year with Congressman Mike Gallagher. He's the head of the House's China Task Force, and he says that he does see this as being a part of further hearings on the U.S.'s relationship with China and what, if any, intelligence China was trying to gather through sending balloons over the U.S.
Emily, thank you. Thank you very much. A big question, I think, for all of us in this market now is what does it mean for you if you're invested in Chinese equities? The rally that we've seen over the last 6 months or so, 4 months, go back to the end of October. Baidu since then is up more than 100% since the end of October. It's up 11% today. A year or so ago, China was uninvestable. We said this yesterday. Now, seemingly for many people, it's unavoidable. After the events of the last week or so, Katie Lyons, what is it now? And for this stock, it's got its own story, hasn't it?
Yeah, it's been absolutely remarkable. Obviously, you have the wider picture, the reopening frenzy around China, but you have the artificial intelligence frenzy as well, and that really is what is specific to the Baidu story today. They have said that next month, in March, they are going to launch their own chat GPT-like product, that AI bot that has caused such a stir over recent weeks, John. They are going to call it Ernie Bot for what it's worth, but really this is just evidence of the competition and race to become dominant in AI. That is true for the US and China, but private companies as well. We have seen just really remarkable moves in many different stocks related to the sector, like NVIDIA, for example. There is crazy funding going into companies that are investing in AI. We know Microsoft has unveiled billions of dollars into OpenAI, which is the operator of ChatGPT, and they're scheduled to have some kind of mystery event today, so we'll see what details, if any, we get about that. But just to underscore how much buzz there is about artificial intelligence at the moment, check out a chart my producer Dan Curtis made for me showing the news trend of articles about AI. It has absolutely boomed. You can see that there on the far end of this chart. So really it is about competition and trying to get in on what the market perceives, at least, as the next big thing, John.
Do you remember the end of 2017 where it was everything with Bitcoin and we saw those companies just renaming themselves?
Yep, just get it in the name to get around the hype. It feels very eerily similar.
Everyone piles in. Katie, thanks for that. Katie Lyons there. Abigail Doolittle has the sector price action for you. Hey, Abby.
Hey, John. Yeah, and it's a little interesting here. So we're looking at a small loss for the S&P 500, down about 0.2%, but we have some pretty wide moves. To the downside, it is all about defense, utilities, consumer staples, real estate. They are all down there. Consumer discretionary is also down there, so that's obviously one of the mega cap tech sectors. But the fact that you have consumer staples and utilities down, both of those being high dividend yielding sectors, suggests that on a day like today, when yields are basically flat, maybe investors are expecting yields to go higher. Up top, though, we do have some growth sectors of technology, materials. Energy is also up there. And you and Kelly were just talking about that China tech story. Well, there it is from sort of the October low, but pretty amazing, up 42%. I found another measure, John, up closer to 60%. So yes, investors seem to be back in on that trade.
Abby, thank you. Two main risk events. I guess there's one really. Later, 12:30 Eastern Time. It's Chairman Powell, Volume 2. Any different to what we heard from last Wednesday after that blowout jobs report? 517,000 jobs. No idea where that came from. Unemployment at 3.4%, the lowest since the 1960s, and wages didn't pick up too much. I wonder what Powell thinks about that. Certainly, the President of the United States will be using that report in his address a little bit later. Up next, your trading diary from New York. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
This is Bloomberg.
Twenty-five, 26 minutes into the session. Pretty marginal stuff here, no real drama, as we've said a few times this morning. 3-day losing streak on the S&P. We're down about 0.2% on the NASDAQ, up about 0.1%. That's the price action. Let's get you the trading diary. Coming up, Fed Chair Jay Powell speaks from Washington at 12:30 Eastern, plus President Biden delivers his State of the Union address later this evening. We get earnings from Uber and Disney on Wednesday, a host of Fed speak through the week. Williams, Cook, Barr, Bostic, Kashkari, Waller, all on the agenda. Thursday morning, jobless claims onto Friday. The UMich Sentiment Survey to close out the week. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print